For weekly Boston Symphony Orchestra and Boston Pops performances, see new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
A messy quarter gets messier. As we close out the first half, your equity market looks like this. We're down 1.4% on the S&P 500. Had to do a double take this morning as I was going through the numbers, just tallying up how bad it's been. Down 15.7% on the S&P 500 so far in 2Q, and potentially more pain ahead. Not just for the equity market, but for credit as well. We need to talk about this, Lisa. We have to keep going over it. High yield spreads pushing 550, levels we haven't seen going all the way back to December 2018. In December 2018, the primary market seized up. What that basically means is no one was able to come to the high yield market and issue debt, and this Fed had to back away.
You're talking like jargon. It's like Bramo jargon, John. Let's define this. The spread is 500 basis points.
550 close, Tom, yeah.
So the yield is 3% full faith in credit plus 5. The yield on high yield is 8%, right?
It's actually almost like closer to 9%.
Okay, thank you.
On average.
I just wanted to get this into English.
Thank you, Tom. You're translating us. Should we start translating you?
I just thought it was like, you know, it's massive jargon.
Can I continue?
That's a ginormous yield.
It's TK. People need a dictionary to keep up with you. Never mind. We'll carry on. Yields on treasuries. Can I do that?
Please?
Would you like me to define what a treasury is?
No, give
Thank
me the
you.
yield.
Yield's down 3 basis points on a 10-year to 3.0537%.
Well, look at the 2-year yield under 3%.
Look at it go.
I mean, that's
Not sure
like the
where to go
Dow
with this,
under
Tom.
10,000.
Are you going to live blog this market check too? Can I get to the last board? Euro dollar, worst quarter since
Yeah, I would do
2016 for the
FX.
single currency, would you? 104.12. Next hour, Tom Keed standing out here breaking down a market reports for you.
Yeah, you should see me standing out there.
Can't wait for that.
121.22 in sterling. John, to your point about the quarter, has anyone framed that the third quarter could be like the second or the first quarter? I don't think that's out there.
In fact, the equity market bulls who haven't changed their view on things think that we can get a recovery in the second half. We talk a lot about Marko Kolanovic of JP Morgan.
Yeah.
He thinks the bar is so low that you can get a recovery of the losses from the first half in the second half. That's a big, big call.
Mark Howard with us now, BNP Paribas, senior multi-asset specialist with a lot of years of experience under the belt. Mark, where do you hide this morning?
Well, Tom, it's a tough market, but we made it through the second quarter. I think that's the takeaway today. It is not likely to be as bad in Q3. The headlines are going to be worse. And as someone mentioned earlier, we've got some profit warnings coming out. But the place to hide, I think, is in high quality, in shorter duration, and importantly, in really liquid assets, because it's the less liquid parts of the market that are really getting penalized as you mentioned, for example, spreads gap out, and the weaker part of the credit market gets hurt. That's the less liquid part. So you got to stay in liquid securities.
Mark, in a political study of the American monetary history, the Fed always blinks. But in what way will Jerome Powell blink given the cards dealt in this coming third quarter?
You know, I think, Tom, it's important to look at history and understand how both economic and business cycles go. And what we're starting to see is this rotation in what I call corporate confessions. Companies are not just talking about supply chains and higher inflation impacts on margins, but they're talking about demand destruction now, particularly around durables. That's where Restoration Hardware came in with their warning. And I think we need to see more of that. We need the corporate sector to confess and markets to price in those confessions, credit conditions to tighten further. Then you'll get the Fed potentially to moderate. But we still think they're going to go 75 in July and another 50 in September. So we're not there yet on that blink spot.
We need the corporations to confess. The confessions begin on July 14th with JP Morgan's earnings. That is, according to Mark Howard, how much more pain is there in the credit spread space, considering that so many people have been talking about the strength in this area, that corporate balance sheets have continued to be strong, and that they don't have to refinance for years?
Yeah, it was a notable part of the first, call it 4 months of the year, that the credit sector held in relatively well. And we didn't see, what's known as decompression between the lower part of the market and the higher part of the market. Everybody was focused on the negative returns due to long duration investment grade, both in the US and in Europe. But now we've seen that pivot into the high yield and to a degree the leveraged loan market. And I think for the spread market to wash out, we need to see this backlog of primary, particularly in the high yield market, to work its way through. In the U.S., we think there's more than 80 billion of bridges that need to be termed out, and there's a little bit of cat and mouse going on in the loan market with the CLOs and other LevFin investors waiting for that market to clear.
Yeah.
And as that clears, then you'll see a little bit more normalcy.
Let's break this down. A lot of big banks were guaranteeing certain loans to finance mergers and acquisitions, and they had them on their books, and they cannot get those loans off their books right now because they can't at least set prices they're willing to accept. How much will that actually create some sort of fission in markets, some kind of market dysfunction that a lot of people have been worried about, Mark?
Lisa, I think absent some extraneous shock, I don't think you'll see dysfunction. Those bridges and those other financing provisions can last for some period of time. There are price adjustments, there are covenant adjustments, there are other things that can be done. There's no ticking time bomb. And importantly, as you know, and you've talked about, the private credit market is becoming increasingly able to absorb either non-standard transactions, hung transactions, or others. And so there's a whole separate ecosystem of potential lenders just at different prices that can step up. So I don't see any real dysfunction occurring anytime soon.
Mark, I look at, we talk about spreads and about yields and all that. Are we going back to something we remember, or are we carving out something new after this massive fiscal surge of the pandemic?
Well, Tom, I think we're going back to something we know. Granted, you have to be a little bit older than many in the market to have lived it, but we're going through a period of elevated global inflation, and that takes a while to work its way through the python, and it takes some aggressive steps by central banks. We're going to see Colombia likely to raise more than 100 basis points. We're seeing other emerging markets do that, and of course, you heard yesterday in Portugal, all the developed market central banks are also on the case. So, we've been through hiking cycles, but none that are so focused on inflation for a long, long time. And so that's why we're moving from a macro reset in the first half of this year into more of a micro reset in the second half of the year. But once we get through that micro reset, then I think you're going to see a more normalized market, and the Fed's going to start to moderate.
When does the dollar stop being the haven?
There's a lot that goes into that, Lisa. I think, obviously, cross-currency relationships are central to that. But also, as you mentioned, and we heard from NATO, there's a lot of political and budgetary and other dynamics within different countries that could cause a central bank in one country and another to blink. But I think it's going to be, the dollar has had a massive move. Our team thinks that we're going to see a gradual reversal in that, but not a dramatic reversal. So the dollar's, still going to be strong, but not as strong and not relatively as strong as we've seen.
Mark, thank you, buddy, to give us your thoughts. Thank you, sir. Mark Howard there of BNP Paribas. Kit Jukes addressed this over at SocGen in his morning note. He said central bankers are committed to slower growth. Some concluding remarks on the dollar. None of that suggests that the dollar's rally, Lisa, is over yet.
And that seems to be the conclusion. I mean, even George Saravelos, who came out with a study of the lack of a true correlation between a global recession or even a U.S. recession and where the dollar is going to go, conceded that it is very hard to say. And it seems like right now the dollar continues to be the place because things are so much worse everywhere else.
What's known and what's well priced? I keep coming back to that, and I keep picking up on the retailers as an example of something that you think is well known but just turns out to be appallingly priced. We can go back to Walmart. I was making a note of this stuff yesterday. May 17th, they came out. The stock was down by more than 11% that day. Target followed a day later. The stock was down 25%. We're all scratching our heads and thought, well, this story's obvious. Why hasn't it been priced? Then Bed Bath & Beyond happened. yesterday, Tom, and just added to the whole pain. That stock was down about 24%. So you're seeing the market cap of some of these companies, just a quarter of it, sliced off on a story that people seem to think is obvious and well known.
As I mentioned earlier in the week, HSBC went to long on luxury. This is about the deciles of the American economy, John, and all these this recession talk is driving me nuts. The recessions are simple. Across deciles, 10% pieces of America, the recession hits hardest the broad middle class, and indeed down to the poor, as the poor are always hit. Those venues you're talking about serve a part of America that's already flat on its back.
That's the approach that UBS is taking, Tom. The team put out a report this morning on the consumer headwinds.
I missed
and when it came to food products, greater exposure to lower income consumers, that's where they're most negative.
I loved what Mark Howard said there, John, about macro and micro. I'm a big believer that you need microeconomic foundations to understand the macro blather. And like in oil, I think it's really critical to look at the micro parts, and part of that is the responsiveness or elasticity of demand destruction. And right now, that's one of the great mysteries of the first 2 or 3 weeks of the third quarter.
Well, it's the winner of the first half, that's for sure. Lisa, if you can find one in a very, very ugly equity market, it's energy. But more recently, things have started to get very volatile for that particular industry group, but that's been a story of the first half, nevertheless.
Well, Hugo Rogers was talking about this, how they're starting to second guess it because they're seeing the demand destruction. But it folds into the same retail story because the demand destruction that you see in gas prices also happens at certain retailers. How much, though, is idiosyncratic? And I know that this word is a flash word for criticism, but in terms of each company and how they arrange the mix of products, we go back to the rapidly changing consumer appetites in addition to potential consumer demand destruction because of the higher prices of gas and food.
This is a jargon-free zone now, Bramo, for the next 4 minutes or so.
Is idiosyncratic jargon?
No, it's okay. You can use that word.
Okay.
Just, you know, to reiterate.
No spreads.
Just jargon-free for the next 4 minutes, and 3 of that were in a commercial break.
Let's look at our summer
Futures
reading.
down 1.5%.
John, I think,
on the S&P.
The summer reading, we've got a number of book covers. For those of you on radio,
what's your book
Richard
cover?
Haas, The World.
Nice.
We can look at Richard Haas, The World. And we've got Robert T. Kaplan, The Return of Marco Polo.
Cool.
And we've got Gandhian, The Myth of American Politics.
All right.
They're all good reading.
We're on form this morning, just 3 different shows all at once.
You know.
This is good stuff.
It's good summer reading.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia is confirming that it has withdrawn troops from a strategically important island in the Black Sea. Word of that came after Ukraine says the Russians were forced to leave because of its missile and artillery strikes. Moscow says the troops were pulled out to help with grain exports from Ukraine. Talks in Qatar this week to revive the nuclear deal between Iran and world powers have made little progress. That's according to the European Union diplomat mediating the discussions, Enrique Mora. Iran's semi-official news agency says the U.S. didn't show enough flexibility over Tehran's need for a guarantee of economic gains from a new agreement. In China, the economy showed further signs of improvement this month. The Manufacturing Purchasing Managers Index rose, although the gains were less than expected. Meanwhile, the Non-Manufacturing Index, which also measures construction, climbed to the highest level in more than a year. Spirit Airlines has again delayed a shareholder vote on its proposed merger with Frontier. The low-cost carrier says management needs more time for talks both with Frontier and rival bidder JetBlue. Spirit CEO Ted Christie says merging with Frontier is the right move.
What we're fighting for is a bigger, stronger business. And while there is, risk on the horizon of recession or whatever that is, this business will recover. It has been in a difficult period over the course of the pandemic, and the right place for investors to be is in the low-cost side. And so a combined Frontier and Spirit gets that done.
The Spirit shareholder vote has been set for today. It's been rescheduled for July 8th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I don't think that we're going to go back to that environment of low inflation. And I think that there are forces that have been unleashed as a result of the pandemic, as a result of this massive geopolitical shock that we're facing now, that are going to change the picture and the landscape within which we operate.
These were fascinating remarks from President Lagarde of the ECB. They came early in the panel yesterday afternoon over in Sintra, Portugal, alongside Chairman Powell, Governor Bailey, and our very own Francine Lacqua. And Tom, it made me think a little bit more deeply about ECB policy and whether you can reconcile it currently with what she's saying here. The ECB president is telling you we're not going back. You've got Fed officials, namely Loretta Mester of the Cleveland Fed, suggesting that the biggest risk is doing too little, not doing too much, to get inflation expectations back down. And you've got an ECB chief at the moment pledging gradualism. Now, she's also talking about optionality, so I wonder how quickly they have to retire that word gradualism. It's an imperfect comparison, Tom, to compare what the Fed is doing with the ECB at the moment, because they have two different situations. But it's the same story in another way. And they're addressing it, approaching that story in slightly different ways. You've got a Fed that's front-loading, Tom, and an ECB chief committed to gradualism, which I think means 25 basis points, 25 basis points. Let's wait and see. And I think the big change could come later in this summer. Either the Fed is going to be wrong or the ECB will be right, or vice versa. But we'll find out, Tom, later in the year.
They can be both right in the sense, we don't have the time here to talk about this, but John, I would suggest that they're both adapting to their economies. Mr. Powell can be a little more front-loading because America's a stronger economy.
That's a good point.
All in all, I think that overweights all. We can talk about this optionality. I think it's important. Right now, the optionality with oil, 120 print yesterday on Brent, down $5 to 115. Ellen Waldjoyne, senior fellow of oil volatility at the Atlantic Council this morning. Ellen, media people throw around the phrase demand destruction like it's a mint. What is demand destruction and how does it happen?
Demand destruction is essentially when people stop buying the products simply because they're too expensive. So they're making decisions like, I'm not going to go out and drive because I can't afford to put gasoline in my car, or I'm going to slow down manufacturing because we don't have enough natural gas. So we are starting to see people make these decisions.
And what's critical here is it's a non-substitutable product where on a unit basis, they just say, I'm not going to drive, which tells me units are sold less and then price follows, right?
Well, that's what you would definitely assume would happen, because as you get an idea that there's less demand, or at least less demand than you were expecting, then you would think that gasoline stations will say put in orders for less gasoline, and that will kind of trickle to the prices. But sometimes it doesn't quite work like that.
Well, so Ellen, let's build on that, because right now what we're seeing is a real division between the physical market and the futures market, with the physical market highlighting the tightness of the moment, the lack of supply relative to demand, and the futures market trying to gauge out how long it will take before that demand destruction works its way through the channel into cheaper prices. Where is the disconnect, and where is it getting it wrong?
Yeah, this is a really tough thing for the market to figure out, because there's also, and you also have to factor in seasonality, because demand for gasoline in particular, and also natural gas, has a seasonal component. And so it's generally less in terms for gasoline in the winter months than it is in the summer months. So there's also that factor to put in as well. I think that we're definitely seeing a disconnect, particularly in terms of when they think a recession might hit, because that can typically also act as a big demand destruction factor. When it hits could be very important in terms of when we do see demand destruction and then prices start to come down. But then there's also a factor of, if at a certain level, gasoline is a necessity. Yes, if there's a recession and people are out of work, they're not going to be driving to work. But if there's not quite a recession and people are still looking to drive to work, then they're just going to be prioritizing their purchases of gasoline over other purchases.
So Ellen, to really underscore the point, we just saw, if this continues, the first monthly decline in oil prices going back to November of last year. Is this the beginning of a trend or an anomaly as people reset their expectations for growth?
Well, I do think people are resetting their expectations for growth, particularly because the indicators for recessions in the Eurozone and also in the U.S. are growing more apparent. And even in Europe, we could see some types of rationing implemented, probably first with natural gas, but gasoline could follow. And I do think that we're seeing that being priced into the market now. The real question, though, is whether we're going to see some kind of resolution to the Russia-Ukraine crisis, because that's really what could start to bring down prices in a more substantial way. And in fact, I would argue potentially that if we could bring down oil and gasoline prices, we might actually be able to avert some of the worst parts of the recession, because people would be extremely relieved if prices, say oil went down to $80 a barrel. Would be a huge relief for many.
Ellen, drag us into July. Does Riyadh, does Abu Dhabi have the marginal production to change the price of oil in America, the price of gasoline and distillates in America?
Yeah, that's a great question, and I actually just wrote about that. And I would argue that they don't. They do have more capacity and that they can add. They can produce more, but I don't think that they will add all that much more or enough to affect the price of oil, because I think the price of oil is really being acted on so much by this Russia-Ukraine crisis that even if they did add, say, 1 million more barrels to the market combined, I don't think we'd see a substantial drop in prices, simply because there's so many other factors like inflation and this Russia-Ukraine crisis that are pushing prices up.
Ellen Wald of the Atlantic Council. Ellen, thank you. Lisa was working through the inflation numbers this morning, just looking at break-evens in the bond market. They're getting hammered. They're going the other way.
basically what you're looking at right now is people pricing in the recession that the Fed may end up causing, right? That this will not dissuade the Fed from continuing to raise rates, and that over the longer term, we do revert back to a low-inflation environment. How gasoline fits into that, though, is so interesting, especially given the fact that if it stays as high as it is, it will spur the recession itself or exacerbate it. And so how does that fit into the inflation picture?
How much longer can these price pressures persist, particularly in energy, Tom, against the backdrop of weakening growth that's showing up in the data week after week at the moment?
Let's go back to Lagarde and optionality. John, let's take Spain, 10% inflation just because it's a round number. The path down from 9, 8, 7, 6, I mean, that's going to happen some way or another, and she'll be able to maintain optionality. My study for the third quarter is, let's say they get to 5% inflation. You pick a country, it doesn't matter. The incremental steps from there greatly are diminishing the optionality, the degrees of freedom that central bankers have. That's when it really gets hard.
The Fed has core PCE at 4.3% year end. Lisa, 2.7 next year, 2.3 the year after.
Is it going to be fantasy land? That's my key question, whether this is actually going to be enough to really give some conviction that they're getting inflation expectations under control.
Kathy Jones of Schwab nailed it, didn't she?
Yes.
When she came on this show and called those forecasts aspirational. I think it was Dan Swank, Grant Thornton, that said they were fanciful up front as soon as they came out. Futures down 53. We're negative 1.4% on the S&P. On the Nasdaq 100, we're down by 1.6. From New York, this is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Fighting inflation and winning this battle is the single most important thing facing central banks.
We think we're looking at a mild recession starting sometime mid-2023.
We think there's a high risk of recession, particularly if the Fed goes really hard and fast.
Even if we have recession fears, the central banks are in a very, very tricky spot, right? Because inflation is way above target.
Right now, what is impacting the consumer are necessities, and that's shelter, that's food, and that's inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Brutal first half, ugly second quarter from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures TK down 1.3% as we look to wave goodbye to a brutal first half.
Yeah, you say brutal first half. I'm going to say brutal Thursday, John. The tape here and some of the micro details of the tape. Forget about BitDog down 19,000 through 18,000 with some bankruptcies. Liquidations is what the British call that. John, I'm looking at oil, 120 up to 115. I mean, that shows you recession, economic growth, slowdown. And the litmus paper of the global system, everybody but yen screams strong dollar this morning.
TK, this has been a problem for a lot of people. This has been a difficult message to swallow. This Fed wants to get inflation down. Tighter financial conditions are part of that objective. And even with the price action we've seen, you've got a Fed chairman, and this is different to what we've seen in the previous 10 years, endorsing it. His words yesterday, markets have been pretty well aligned to where we're going.
Moments ago, John, a 103 print on euro. That speaks volumes. Congratulations to Jordan Rochester and others that called for this trend. I'm sorry, John, right through 104, 103.97 on euro. That's the challenge Christine Lagarde has. That's how central bankers become overcome by events.
103.80, the closing low of the year, so we're just off those levels at the moment, but largely off the back of some pretty bad data, Lisa, whether it's Europe, the United States for that matter. More data stateside this morning, then onto the ISM tomorrow.
All pointing to some sort of downturn that the Fed perhaps is not going to respond to by easing off the pedal. Yesterday, picking up on the comments that you were making yesterday about yesterday's central banking discussion yesterday with Francine Lacroix, John, I was struck by what Christine Lagarde said. I don't think we are going back to that environment of low inflation. This is a sea change that profoundly reshapes what the reaction function will be.
And that low inflation regime gave them more space to step in when things started to go bad in this market. They're not doing that this time around. If you compare the credit levels now in high yield, the junkier part of the credit market, to where we were in late 2018, we're at those points right now. Except back then they had low inflation, they had the capacity, the space to back away, to have a little bit more of a dovish stance. Lisa, they're not doing that this time around.
How much has this market priced in the new regime that we have from central bankers and the new reaction function that has a much higher tolerance to market pain? That, I think, is one of the key questions heading into the third quarter.
John, you know, you and I are in Washington next week or the week following. I can't remember, but I'll tell you, top of the pile for me is Adam Posen of the Peterson Institute, because out of that panel yesterday, you wonder what the new 2% is. I'm fed up, even with institutional people with institutional responsibility voicing that we need to get back to 2% inflation. That's just baloney, according to Adam Posen.
I've got it in the diary for Thursday, Tom. Thursday.
It's next Thursday?
It's next Thursday.
I don't know if I can make that.
I'll make sure you get to the airport, okay? I'll hold your hand.
I think I've got Vetbill has a doctor's appointment.
We'll work something out. Futures negative 1.4% on the S&P. On the Nasdaq 100, we're down about 1.7. Bramo's flying out on vacation tomorrow afternoon.
I didn't know this.
Gone, Tom. She'd just gone. It's a race to
paradigm.
JFK for Bramo. Yields in 4 basis points on a 10-year, 3.05%. And Lisa, things are starting to change a little bit in the bond market, up about 70 basis points over the quarter on a 10-year, but backing away more recently as that growth data starts to come in negatively.
Which is a huge question when some people are forecasting, including our next guest, that benchmark rate could go up to 4%. How does it get there if people are currently bidding in now to longer duration bonds because they do expect that slowdown to take hold next year? Today, today, what we're watching, OPEC Plus holding a meeting on output. How much can they ramp up production? How much can, Tom, your question earlier to Ellen Wald, how much can they offset how high prices have gone on gasoline in the United States? We have seen the first monthly decline in crude prices going back to November. Is this a trend, or is this a momentary blip as people reassess growth expectations? 8:30 a.m., the U.S. data dump, personal income, personal spending for the month of May, as well as U.S. initial jobless claims. Did we see the trough of jobless claims back in March of this year? Have we started to see an increase that steadies and grows higher as people try to figure out whether we are going to see some sort of higher unemployment rate in the face of tighter financial conditions? And aftermarket, I am watching this because increasingly the corporate story, each individual one, really may tell the macro story that we need to pay attention to. Micron Technology reports their earnings. We have seen a huge decline in shares this year. How much do they point to a decline in the demand for memory chips, as well as supply chain disruptions, as well as how much companies are investing? John, how much are these tea leaves really going to determine the shape of the narrative over the next few months?
Elisa, thank you, particularly over the next few weeks as well. Closing out June and looking ahead to July. July 13th, CPI in America. July 14th, JP Morgan kicking off things for the banks in corporate America. Looking ahead to earnings. Looking ahead to what this bond market is going to provide for this Federal Reserve in its next meeting. Mike Schumacher joins us now, Global Head of Macro Strategy at Wells Fargo. And Mike, Lisa, Tom and I are trying to work out where the buy point is in this credit market for this Fed to have a rethink. If it's not where we are now, where is it, Mike?
Yeah, it's interesting, John. If you look at high yield, typically it peaks at about 10% in the cycle. Right now it's high eights. So I would say that's 10-ish, maybe somewhere around there, but nowhere near current levels. The Fed's looking right now at the tightening conditions and saying, yeah, it hurts. Yeah, it's painful, but this is a feature. It's not a bug. We're going to see more of it.
Michael, the clear theme here, and particularly off the important panel yesterday, is the Fed and other central banks are resolute. My reading of Meltzer, Anna Schwartz, Friedman, Richard Timberlake of the Georgia School is simple. That's baloney. They always succumb to the political zeitgeist, the political pressure. Is it going to be the same way this time?
I suspect the Fed and the other central banks will feel a ton of pressure from the politicians, Tom. It's almost inevitable. But the question is how quickly they, I wouldn't say cave, but have that impact their decision making. And for Chairman Powell in particular, it's really a challenge because he's got to look at that wall down at the Fed and say, you know what, Arthur Burns, worst chairman ever. William Miller, probably a close number 2. I don't want to be number 3. I've got to fight inflation. And I think that that personal legacy is going to outweigh the politics for him for quite some time.
Michael Schumacher, harsh today.
Well, Mike, given that harsh view and given some of the bearishness that you have currently looking at this market, how do we get to 4% on a 10-year Treasury yield, given that we are looking at such a pessimistic scenario that usually sends people back into bonds?
Yeah, Lisa, it's really interesting. I think you've got to break it down into where does inflation end the cycle and what sort of real rate is going to be implied or expected at that point in time. So we think probably core inflation that is, ends the cycle maybe 250, perhaps a bit higher. And real yields, at least in our view, Wells Fargo, have to be 150 plus. So that gets you to 4%. You might say, well, wow, 150 with a recession, how can that happen? Think about the last cycle. Granted, fairly mild, but still, at the end of that cycle, you had the real 10-year rate about 115. So 150 with incredible inflation, and really the Fed wanted to take out insurance against that inflation genie coming back out of the bottle. That seems pretty reasonable to us. That's how we get to 4.
What does 4% on a Treasury yield, for a 10-year Treasury yield, do to U.S. equities?
That's a really rough ride. So I think if you do get 4% on 10s, certainly speed matters. But let's say it happens sometime around the end of this year. It takes stocks down quite a bit. I'm not sure if they get down toward 3,000. I'll leave that to Chris Harvey, but it's going to be a pretty painful journey.
We'll catch up with Chris later and ask him that. Mike, I just want to finish up with your reflections on yesterday. What was the big standout thing for you? Listening to President Lagarde, listening to Chairman Powell, listening to Governor Bailey too.
When I listen to those 3 central bankers, John, it strikes me the ECB's got the toughest job. Certainly it's most closely impacted by the situation in Russia and Ukraine. And I listen to Christine Lagarde and say, well, okay, so the ECB's history of rate hikes is not particularly great. And on top of that, you've got the question of gas flows. I would circle in bold red, July 21st on the calendar. It's the ECB meeting. And also, perhaps more importantly, that's the day the Nord Stream pipeline comes off maintenance. Will the gas go back on? How much? that's going to drive policy for the ECB. So they're all uncomfortable, but I think that's the central bank that's got the biggest challenge ahead.
Fascinating stuff, Mike. Mike Schumacher there of Wells Fargo. Just finishing up on the ECB there, TK, as you look at euro dollar clinging to 104.
The litmus paper, the global system, sterling now real near a 120 print. Not a headline. I mean, I guess 119's a bigger deal than a 120, John, but I'm sorry. Foreign exchange speaks volumes. What's not moving today? You know what? It's Japanese yen. Maybe they've got the day off over there. I'm unsure. I don't have yen at 137, but you got to triangulate. You can't just look, John, at dollar or at one pair like euro dollar. You've always got to triangulate it with a second pair to pick up the three relationships. And you do that today through euro yen, which shows you weak euro.
Right now focused on that ECB, July 21. Lisa, what a tough moment for the European Central Bank. To Mike Schumacher's point, the ECB president wants to be gradual. We've seen the mistakes of hiking cycles in the past, going back to the last one in 2011. That didn't last long. Looking at this situation, she wants to come out the gate gradually, 25 basis points. There will be some on that committee who are pushing for more.
Especially in light of the gasoline prices that are getting a little bit out of control and can only be dealt with based on reducing some of the demand. To Mike's point, George Saravellos just publishing moments ago saying we are increasingly concerned that the unfolding energy situation in Germany is going to percolate over and could potentially present some real downside risk to the euro, particularly near the end of the summer.
This is the dilemma that EM central banks have been facing for a long, long time. It defines the EM central banking dilemma, Tom. You have a choice. Do you support growth or bring down inflation? That's the tough one.
You know, monetary 101, yes, I think that's the answer, John, but I'm going to go back to the dispersion of the pain. President Biden flying, well, he's going to speak this morning, I believe, in Madrid. John, what time is it? I don't know.
8 o'clock.
8 o'clock, okay, fine.
Scheduled 8 o'clock. I have no idea when he'll actually
scheduling this in the
speak.
middle of my opening of that hour? That's just, it's unfair.
I imagine he'll be late, Tom.
Well, okay, thank
It's
you.
unlikely.
That makes me feel
When has the
better.
president ever been on time?
That's true.
Scheduled
When have I ever
for
been on time? Okay.
That's true, too.
John,
That's true.
I'm sorry. They're going to adapt to the politics of the moment. They always do.
Well, this central banker is not adapting to this market. And as Mike Schumacher of Wells Fargo said just moments ago, and this is probably the line of the morning so far, this is a feature, not a bug. We're going to see more of it.
Amy, get the White House on the line. I got to talk to him.
Futures down 1.35% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. China's Xi Jinping has made his first trip outside the mainland in almost 900 days. She traveled to Hong Kong, calling the city reborn since he last visited 5 years ago. His comments were an apparent reference to the sweeping security law Beijing imposed in 2020 that crushed dissent. Xi is marking the 25th anniversary of Chinese rule in the former British colony. Vladimir Putin reacted to NATO's decision to admit Finland and Sweden by saying they're welcome to join. The Russian president said that NATO, including the Nordic nations, is totally different compared to potentially allowing Ukraine to join. Putin also said that if NATO places military personnel and infrastructure in Finland and Sweden, Russia will have to respond. Congresswoman Liz Cheney has warned her fellow Republicans that they must choose between former President Trump or the Constitution. She says they cannot be loyal to both. In a speech in California, Cheney called the former president a domestic threat the country has never faced before. Cheney is vice chair of the committee that's investigating the attack on the Capitol. Suspected North Korean hackers are believed to be behind the recent $100 million heist on California blockchain Harmony. That's according to blockchain forensics company Elliptic Enterprises. Elliptic says the hackers, known as the Lazarus Group, targeted username and password credentials of Harmony workers in the Asia Pacific to break into the platform. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
He is very focused on reducing prices for the American consumers. And knowing that we are going into, and we're already the beginning of the driving season in the United States of higher demand, he wants to see what we can do to reduce the price, even if it's that 18 to 50 cents. If you told the president that he can get 50 cents off for American consumers during this summer, I think he would welcome that, and I think every American family across the country will.
Amos Hochstein there, the Senior Advisor for Energy Security at the U.S. State Department, speaking with Bloomberg's Anne-Marie Hordern earlier on. From New York City, with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures are negative 1.4% on the S&P 500, on the NASDAQ 100 down by 1.6% as we close out the first half and the second quarter. On the quarter, Tom, before today, down by almost 16% on the S&P 500.
Yeah, the drawdown substantial. The NASDAQ 100, again, John, I don't know the statistic, but take Apple and 6 or 7 other stocks on a NASDAQ 100. How much is it down? 40%?
Pretty brutal, TK.
Brutal.
Some of the names inside that index, it's been more than bad.
Right now, we're going to recalibrate. We're going to do that after an eventful week in Bavaria and, of course, in Madrid. The president will be commenting here in 45 minutes scheduled. We'll see on that. Right now, a bit exhausted from the road trip there. Maria Tadeo in Madrid, Anne-Marie Hordern in Madrid, with reporting that Music Box looked awfully good last night at Joya Slava. It was good to see you two shut down the shop about 4 a.m. I want to talk here about the headline just out where the gentleman from Norway, Maria, says Finland and Sweden will be in NATO by Tuesday. I must ask the question I asked you yesterday. How will the Tsar from Moscow respond to American NATO troops on a long Finnish border?
And it's totally doable, by the way, Tom, because, of course, they have the political signal now approved. And if you think about the Norwegian, of course, the Nordics, the Finnish, the Swedish, a lot of the things that they use already when it comes to military capabilities, they're 100% NATO compatible. So they can essentially switch from one day to another and be fully integrated. So that is no exaggeration. I think when you look at Vladimir Putin, he was asked that question yesterday, and he said, to me, the way I see it, this is not going to be a problem. By the way, I don't really get why Finland and Sweden want to join, because we have a very cordial relationship. So what this tells you, to me at least, is that a lot of the narrative that Vladimir Putin only attacked Ukraine, which, by the way, no one behind the scenes would ever tell you that Ukraine was joining NATO anytime soon. That was seen as a red line. This, for him, it's not about the military aspect of it. This is personal. This is about his thinking, which you've talked about many times, that Ukraine and Russia are essentially one people, one nation, and Ukraine cannot be separated from Russia, let alone be separated from Mother Russia to join a Western alliance. So that is the thinking behind this. If you still believe this is about NATO expansion, you're not paying attention to the words of Vladimir Putin.
And if you're still thinking that there's cohesion in NATO, perhaps we're not paying that close attention to the individual stories on the ground. Maria, and before I get to you, Anne-Marie, I do want to get your sense, Maria, of what's going on in Germany, especially on the heels of this George Saravellos note, pointing out that 2 weeks ago, Russia reduced the Nord Stream flows of gas to Germany by 60%. There is a fear they are not going to come back. What is the plan for Germany if that is the case?
Well, right now they don't have one, and that is the issue. And both the Germans, but by the way, the Italians, that's the reason when Mario Draghi is not paying attention to a press conference, he's on the phone, caught on camera. It's that they really worry that we're going to see a unilateral cutoff from the Russians to both Germany and Italy. They don't want to talk about it publicly because they fear that this is going to see a reaction in the market, so we're going to see prices jump even more. But they really worry about this, and they know that it could happen, whether this is a week, a day, or a month. The impact that it could have in the Italian industry, the German industry, would probably take their economies into a recession. That is the biggest worry for European governments in particular. And Lisa, by the way, they have 2 months right now at this stage to fill up their storage, and that would give them 2 months leeway in the winter. But if that doesn't happen and we get to September with the storage not 100% full, then they're going to have an issue in the winter. That's not a secret.
And it's a politically unpalatable message to send to your populace to say, stop traveling, stop doing things, stop exploring post-pandemic. Anne-Marie, from that perspective, how does the U.S. president really dovetail the message of European stability and potential crisis in the energy space with the issue at home of trying to reduce gas prices, considering the fact that they want to supply Europe with oil, with gas, but they also want to ease some of the consumer pressure locally?
Well, this is a question I asked the president just a few weeks ago at some point, and I said, you're a trained man. Are you going to tell the American public that because of this war and the repercussions of it, please start using less energy? That's what the chief executives of a number of French energy companies had to come out in an op-ed asking French consumers and French corporates. Because as Maria says, this winter is going to be incredibly challenging for Europe, considering we're already seeing President Putin play politics with gasoline. I mean, this is obviously going to be a question for the president today. Yesterday, I spoke to his, what is known in Washington, D.C. now as his energy whisperer, Amos Hochstein, and said, why did you go ahead with even this attempt at a gas holiday of that tax if you know Congress is not going to go on board with it? But this administration wants to be seen as they're doing everything, including going to Saudi Arabia. And a more interesting part of that conversation was when he said that step one was recently OPEC saying they're going to come out and produce more, and then they're hoping to move to step two. And I'd like to talk about that in the future, Anne-Marie, is what Mr. Hochstein said. And I said, okay, we could do that in Jeddah. So that is what this administration is hoping for, more barrels on the market around the world to bring prices down.
Anne-Marie flying to Jeddah sometime soon. AMH, thank you. Anne-Marie, alongside Maria today, two of the best. TK, the problems in store later this winter for Europe, they're already preparing for it. When you listen to Anne-Marie and what's coming out of places like France and Germany and Italy, they can see what might be on the horizon here, and it's not pretty.
Yeah, it's not pretty, and it's a bigger thing, and it's also about logistics. It's about moving around and storing actually what they have. You know, people talk about a Marshall Plan. Well, you got to get in the boats, move the boats over, and then what do you do once the boat's at Rotterdam? I mean, that's basically what this comes down to. It's a lot harder to find the storage than, you know, glib talk in the media.
Tom, I'd be interested to see how much this president gets out of his Middle Eastern trip, because Emmanuel Macron, the French leader, made himself heard, didn't he, in front of cameras, on microphone. It's pretty obvious what he was doing.
Yeah, I can see
looking like he's in the know, telling him that basically that their partners in the Middle East don't see the spare capacity that a lot of people would hope is there.
I see Mr. Macron off to the side here, folks, speaking right now as the president will speak here in about 30 minutes. John, to me, you know, it's the lady said in Madrid, it's about the calendar. It's June. We're into the third quarter. I'd focus on that.
Futures right now down around about 1.3% on the S&P 500. On the Nasdaq 100, we are down by 1.6%. We are closing out the first half in a way that dominated the first half, with a lot of red. Yields are down 4 or 5 basis points on a 10-year to 3.04%. Looking ahead to some economic data later this morning. Initial jobless claims at 8:30 Eastern Time, so an hour and 5 minutes away. Then on to tomorrow when we get an ISM print in America. From New York City, this is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070.
Connection lost.
But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This has been painful. Painful for the equity bulls, painful in the bond market too. Losses in equities, losses in bonds, and losses right now on the S&P 500. Futures down by 1.3% on the session. On the quarter before today, we were down by 15.7% on the S&P 500. Equities have been down, yields have been higher. But more recently, things are going the other way in the bond market. Let's talk about it. 2s, 10s, and 30s. The data, weaker. Last week, the PMIs. This week, we've seen a range of regional Fed indexes, manufacturing prints from the Dallas Fed, the Richmond Fed. Disappointing. Looking ahead to the ISM tomorrow, and yields have gradually started to come back in, down 5 basis points today on a 10-year to 3.04%. So yields in on treasuries and corporate spreads wider. So, Tom, this is the additional yield that corporations have to pay over the risk-free asset. Credit spreads. We can talk about them right now on high yield. Tom wanted a definition in the previous hour, so that helps us all out.
We're all jargon in this hour.
So picture this chart, just in your mind, if you don't have the TV on and you're listening to this on radio. High yield spreads. You'll see 3 peaks. One at the end of 2018, one in the mess of 2020, the pandemic, and then one right now. Those 3 peaks. Just think about those 3 peaks on high yield credit spreads, and we'll get up the chart for you as well on Bloomberg TV eventually. And what you'll see is 550 at the right end, which is where we are right now. And at the end of 2018, 550 basis points there. And in between, just parabolic mess. The first one is a problem. At the end of 2018, inflation was still low. The Fed could back away. They turned dovish. The second one was a massive problem. Inflation was very low, and this Federal Reserve could back away and be max dovish and throw the kitchen sink at it. The third peak that you see on that chart, that is a feature and not a bug in the minds of Mike Schumacher of Wells Fargo. And Tom, that is a very, very different story, because this Federal Reserve is trying to get inflation down, not up. And as they do that, they want tighter financial conditions. So when you hear people say this is a feature, not a bug, Tom, that is a very different story that you've got to try and get used to.
My theme here for the third quarter is it's 2-part. You've got an easy move on inflation as we take out some of those non-core features, and then it's very heavy lifting from, I'm guessing, 5%.
Tom, I think that was jargon-free. I think it was. You looked like you're in pain. Okay.
No, I just, you know.
All right. You know, the silence doesn't work on radio at all, Tom. Helpful. Okay. Let's just cross-asset price action. Let's get some single names. We can do that this morning with Bramo. Good morning, Lisa.
Good morning, John. And to pick up on the story that you're talking about of a Fed reaction that is not going to come in to give free money to this market, to save the market, highlights the froth being taken out of the market. And you can see it with specific names, especially as BitDog, as Tom likes to call it, or Bitcoin, goes from as high as north of $47,000 in March to now below $19,000 at one point. We are looking at an absolute mess in the Bitcoin, in the crypto space more broadly. Coinbase down nearly 5% ahead of the open. We've got Marathon Digital also down 4.3%. The interesting thing here is the Peter Shear's story of how much more broadly this pain will be felt. And NVIDIA, the chip maker, a perfect example of that, with their chips being used in a lot of the mining technology that a lot of crypto asset fanatics use. Those shares down 2.2%, following a nearly 47% decline that we've already seen this year for this space. If you take a look at some of the other areas that I'm watching, it's really the retail space. And we've been talking about it throughout the show, some of the earnings and some of the calls that have been dramatic. I'm thinking of Carnival. Shares down more than 14% yesterday after Morgan Stanley had a bear case of the shares going to zero. Now they are continuing that with a 3.5% decline ahead of the open. Restoration Hardware, the other one after earnings yesterday, reducing the forecasts dramatically for what they expect with earnings this year because of a lack of demand. Those shares down nearly 9%. Again, really confirming that story, Tom.
And what's great about Restoration Hardware, Lisa, is on page 482 of their catalog, you can buy oil drums from Restoration Hardware to put in your living room.
Thank you, Tom. I will check it out and pass dramatically on that. And then Amazon, I'm also looking at, with shares down nearly 2%, even after the complete butchery this year. And I don't think that you can buy barrels of oil.
I don't think you can either. What did Aaron Brown of PIMCO say yesterday? It was the Amazon recession. It's already here.
Exactly.
It's already here.
But to your point, John, it hasn't been fully priced yet because we see the declines continuing. in the shares as we get some of the tea leaves.
Well, I have to agree with Lisa, Tom. She's just spot on this point. We keep bringing up the consumer headwinds, the pain that's about to take place in retail, and usually when something is so talked about, so well understood, seemingly, you'd think it was well priced. And then every time a retailer comes out with these numbers, they get hammered. And I don't mean by 5%. I mean by numbers like 8, 9, 10, or say 25 if you're Bed Bath Beyond and Target.
We get through June 30. Imagine what we're going to see next week as the general counsel says you've got to get out front of this so there's less surprise for sell side, less surprise at the earnings conference call. Right now joining us, and it's a font of brown wisdom at Morgan Stanley, whether it's Andrew Sheets or Daniel Skelly joining us, head of market research and strategy for Morgan Stanley Wealth Management this morning. The textbook is Money Illusion, which is corporate America has a real growth lousy, plus a big inflation, or we think in real terms. Are corporates right now thinking in nominal terms, where it's actually a pretty good spirit out there, or are they inflation adjusting like everybody else is down to near recession?
Good morning, Tom. It's fantastic to be back in studio. I think they had been thinking more nominal, but it's starting to shift towards the real terms.
I agree, and this is what happens. This is the history of this going back to 74, 75, I would suggest.
Absolutely. And I think, when you look at measures and surveys of corporate confidence in particular, you are starting to see deterioration on the margin there. And so one of the bull cases had previously been, of course, that we're going to see a CapEx cycle and an investment cycle here. And that's one of the, the items on the horizon that I think might be certainly concerning.
Dan, you nailed it this year, and you've been bearish on the equity market, but I wouldn't say you're overly bearish on the economy. Even if we do get a recession, you guys are looking for a shallow one. The next shoe to drop for you guys is earnings. So I want you to run us through where you think that pain is going to be concentrated and how poorly priced you think pockets of this market still are, even with this monster correction we've had this year.
Jonathan, you just alluded to some of the issues concerning retail, which we continue to see. I think when you think about the over-earning that went on, plus cost pressures, plus low-income consumer headwinds coming from inflation, it's almost like the perfect storm for that particular sector. So we see further pain to come, Jonathan, on the retail front and other pockets of consumer. I think industrials is another area where you have to be cautious this quarter. We've seen a strong dollar. We've seen particularly acute weakness in Europe. The economy there is in much more dire shape, right? So I think industrials is another area you need to be thinking about on the cautious side.
Dan, the index has been mechanically challenged because of the pain we've seen in tech. Can you start to lean the other way? Do you think there's more downside at the index level too?
It's fascinating. We think that we've seen phase one of the bear cycle that we've talked about kind of ad nauseum from really the end of last year. When you think about phase two, it's more earnings related. So we're really going to start to see the veil lifted over the next, call it 5, 6, 7 weeks. Look, as it pertains to tech in particular, there is a bit of an ironic nuance here in that they had the most susceptible valuation risk as rates shot higher this year. But on the earnings front, we think you could actually make a case that tech and growth-related earnings may be more resilient. Two things to corroborate that statement. Number one, when you look at a company like an Accenture that just reported a week ago, a very broad read on the digital economy. They're one of the biggest digital consultants out there, vast geographic and industry diversification. They actually said demand continues to grow in 13 out of 15 sectors that they cover. Number two, Morgan Stanley's CIO survey from 2 weeks ago said that software spend and corporate enterprise security spend is slowing a bit, but down to averages that were really just in line pre-COVID. So IT spend, Jonathan, is bending, but it's not breaking. And I think that's a key point for the overall market earnings.
Given, Dan, what that could do to the overall index level, do you think that the pendulum of gloom has swung too much to the gloom side at this point and that perhaps we could be reaching a bottom because of what's getting baked in?
It's all about time frame, Lisa. So I think in the next several weeks, you are reaching that kind of peak uncertainty related to pre-announcement season. We'll see if that happens before July. We've got QT and the shrinking of the balance sheet still in full force. So I think volatility is going to remain high here, and we'll certainly see pretty wide dispersion as we get into earnings itself. So we're not there yet in terms of calling the bottom. It's all about how deep a slowdown and how deep an earnings pullback we could have. Now, as Jonathan alluded to a moment ago, we see this as more of a shallow pullback this cycle wasn't led by leverage and an excess of credit. And that's incredibly important, right? You were talking high yield earlier. Let's just talk about that for a minute. Some of the ghosts of high yield past, energy, consumer cyclicals, aren't really out there to haunt us today. When you think about some of the most fundamentally well-positioned sectors, energy, hotels, airlines, as everyone's trying to travel. I don't know if you've tried to fly recently. It's not pretty. But nonetheless, we don't see credit being the source of this cycle's issues, and thus, we don't see a huge earnings or economic contraction.
Who told you about Lisa's flying issues?
Seriously.
Eh? You know that winds her up.
Oh, my God.
Dan, it's good to catch up. Dan Skelly of Morgan Stanley Wealth Management. Those two industries, how capacity constrained at the moment. Energy one. Lisa, that's a story the last few years. And then the airlines more recently, they are just not adding on the capacity, and there are a lot of reasons behind that.
So basically that means expensive flights that may not get you where you want to go. Thank you for that reminder.
Well, I have to say,
ahead of my vacation,
forgive
which
us,
starts tomorrow.
jokes aside, when you search flights at the moment,
right.
And Tom, you do this every single morning. I went past Tom's desk this morning. What's up, United? Just searching a range of flights, almost on the phone. Were you on the phone with an airline this morning too? I think you were.
You know, Francine had such a great panel in
Just
Portugal. She got the Gulfstream. What can I say?
But Tom, on a serious note, you look at those prices, particularly through the end of this year, and you do wonder if they're going to hold up. At what point does that revenge travel story start to head in the other direction?
I'm going to listen to the pros, and the pros to a person say there will be rapid changes within airlines. People just simply can't afford it. I like how Skelly, you know, the English lit up at Brown is something. He's quoting Charles Dickens. It reminds me of the ghosts of Bramall Past.
The ghosts of Bramall Past.
You know, Hartsfield.
The flights that didn't happen.
Stuck in Atlanta.
On
the way to Puerto Rico.
Yeah, well, that didn't happen.
Stacey Abrams stopped by to say hello.
Futures are down by 1.6% on the S&P from New York City this morning. Good morning to you all. Your euro is breaking down. Euro dollar 103.87. Closing low of the year 103.80. So not far off. Some real euro weakness in the mix this morning. Some dollar strength through the first half of this year. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Israel is now facing its fifth election in 4 years. The fragile governing coalition led by Prime Minister Naftali Bennett has collapsed, setting the stage for an election November the 1st. The end of the coalition could present an opportunity for former Prime Minister Benjamin Netanyahu to return to power. His Likud party is leading in the polls. Talks in Qatar this week to revive the nuclear deal between Iran and world powers have made little progress. That's according to the European Union diplomat mediating the discussions, Enrique Mora. Iran's semi-official news agency says the US didn't show enough flexibility over Tehran's need for a guarantee of economic gains from a new agreement. In Texas, 4 men have been arrested in connection with the deaths of 53 migrants smuggled into the U.S. from Mexico in a sweltering tractor-trailer. All of the victims were believed to have been in the U.S. illegally, most of them coming from Mexico or Central America. 2 of the suspects were arrested on migrant smuggling charges. The other 2 are being held on gun charges. And the travel chaos in Europe has gotten worse. 2 of the region's largest airports, London's Heathrow and Paris Charles de Gaulle, are cancelling more flights. Heathrow asked airlines to cut 30 flights from their schedules today. There's concern that peak passenger numbers will exceed the level it can handle. Meanwhile, a strike by firefighters caused 17% of flights out of Charles de Gaulle to be scrapped. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
If we see greater persistence of inflation, that's second-round effects, then we will act full force for it. It leaves options on the table, and that's very deliberate, very deliberate. I mean, I want people to take a message away from that. It's quite clear that as we respond to this shock, we want to have those options on the table.
A chorus of hawks, much more hawkish than they've ever been. Governor Bailey there of the Bank of England alongside Chairman Powell, President Lagarde, and Bloomberg's very own Francine Lacqua. Futures look like this on the S&P. We're negative 1.5% on the S&P. On the Nasdaq 100, we're down by 1.8. Bonds are rallying. There's one for you. Treasuries up, yields down by 6 basis points to 3.03% on a 10-year. And look at this in euro dollar. For G10 today, this is the picture. It's dollar strength with the exception of the Japanese yen. That's that kind of risk aversion story you might expect. Euro dollar 103.92. Support for this pair has been 103.50, Tom. Getting closer to those levels again for a second time this year.
Yeah, we're going to recalibrate. You're going to see that over the weekend. Not that we're to the weekend yet. Claims coming up, the speech from the president coming up as well. John, just some house cleaning. The VIX through 30 to me is a big deal. I mean, I know in the equity space, it's like, well, okay, the VIX is so 1950s, but the fact is the VIX above 30 shows the angst. I'm going to call it, John, the collective angst that's out there this morning. John, also note the 10-year yield. Can we see a 299 handle on 10-year?
I'm with you, Tom. Treasuries are doing something they haven't done through most of the year so far. They're responding to bad news in a different way. They're not the provider of that bad news. We've been talking about higher yields, higher inflation, messy markets, and now starting to see bonds behave like bonds in the way you might expect them to.
For Global Wall Street, get out the pad of paper and take notes. Jane Foley is a student of foreign exchange, yes, dollar-centric, but with Rabobank, far more looking at the linkages between foreign exchange. What I notice irrefutable, and I know that President Trump was way out front on this, Jane, is strong dollar. Trade-weighted dollar by any indices is back to 2003, even back to 2002. What does this signify? significance of a strong dollar back 20 years?
Oh, well, this is, as you say, a pretty strong dollar, but I think what it's reflecting is the riskiness of other assets. I mean, there is a pretty strong correlation or inverted correlation between the dollar on one hand and risky assets. When risky assets are not performing well, the dollar goes up and vice versa. And I think if we look at the tone in markets right now, people talking about a recession, the US recession potentially over the winter in Europe because of gas prices, slower growth worldwide, then that's an environment which the dollar performs well and risky assets do not. And I think that's very much a story that we're looking at right now.
I don't go short term with too much respect for your work, Jane, but I am going to do it here on June 30. Where does euro and yen set up against dollar September 30?
Well, our forecast for euro dollar for a while has been, 103-ish. And the reason for that is that, we have this massive big support level of 103.5. And we're staring really closely at that today. If we go below that, we could see parity. And I think for a while we've been able to outline the risk for parity. And this is to do with Europe. This is to do with gas prices high over the winter. This is to do with that creating these recessionary conditions, stagflation, and that, of course, putting a lot of focus on fragmentation in the Eurozone, which is a bad story for the euro. So that is what we're looking at, I think, this week. But with respect to the yen, well, that is I think a yield story. Now, the dollar's gone up today more than the yen, and it's brought us up to about 136. But actually, if US yields do start to come down, then I think that gives the Bank of Japan a little bit of room to, carry on doing their yield curve control until they want to stop it, which will be when wages begin to go up in Japan.
Jane, I want to stick on the euro for a minute. You're really saying it's quite bearish for the euro right now, which a lot of people see the same, especially given some of the gas constraints for Germany. So why haven't we seen more weakness already?
I think people are only just beginning to come around to the recessionary story for the Eurozone. We've had that as a forecast for a while, and we've been an outlier. But I think more recently, that has become, or that view that we could see recession over the winter months has become a little bit more commonplace in the market. Now, we've got Lagarde still defending the view that she still thinks the ECB, we would still carry on seeing growth in the Eurozone. But the fact that she's defending it again this week, the fact that she's reiterating it, almost sounds like a pushback against the fact that she's aware of these weight of views coming through from the market about Eurozone growth. Now, if you look back to last week, we had the German finance or economy minister talking about the possibility, that we could have maybe supply cut off to some industries in Germany. That would relate to Italy too. Very difficult not to see recession if that happens.
Jane, the spiraling effect of a weakening currency in an inflationary environment is something that is also a bear case because it will only exacerbate inflationary pressures in the euro region, prompting the ECB potentially to act more aggressively, only furthering the downturn. How much are you looking at the incremental weakening in the currency as a bear case for the economic trajectory?
This is really quite interesting, and I think we've seen this quite a lot in the last few weeks, certainly this month, amongst central banks. If you look, for instance, at a speech by Catherine Mann from the Bank of England last week, she was talking about the spillover effects of the Fed hiking by large amounts, and that coming through into the UK, and perhaps setting the scene for a more aggressive pace of interest rate hikes in the UK, just to defend the currency. Now, you can see that already in Norway. Norway hiked interest rates recently by 50 basis points. Bigger than expected. It only served to stop the currency going down. It didn't push the currency higher. The Riksbank today, 50 basis points, not an awful a lot of gain for the currency, etc. So we're seeing this momentum where central banks have to go big because all of the big ones are going big. And as you say, that can just accentuate the downside risks in terms of demand. And whilst that might fit well perhaps for the US, maybe for Europe and certainly not for the UK, will that be necessarily suitable when you have less wage inflation and perhaps more vulnerable demand there?
What a great point. Jane Foley there of Rabobank, the head of FX strategy. TK, I don't know about you, and I won't speak for Lisa, I'll speak for myself. I've been surprised by how few people are talking about exactly what Jane is talking about. The challenges in the FX market that are emerging for, say, the UK with cable at 120 and the Eurozone with euro dollar at 103.90 right now.
I believe it was February 24th. Folkers Landau was on. We called up Deutsche Bank and said, we have to speak to Dr. Folkers Landau. And that was the first thing out of his mouth, is we're going to see strong dollar and the nations are going to have to adapt to it. He's not talking the angst of a Plaza Accord. I know the theater of the 1980s plays big in the media, John, but there's going to have to be some reaction to this. And you wonder where the level is. I haven't really done the math work other than to say Plaza Accord strength is distant. We're not there yet in any way, shape, or form.
103.87. We've all said this a few times over the last quarter in the first half of this year. It is almost the total opposite of the previous decade. Lisa, Steve Englander of Standard Chartered saying we've gone from Fed put to Fed cool. In this equity market, for risk assets more broadly, in the currency market, it was about having a weaker currency in the previous cycle. Now the big demand to have a stronger one.
And it seems like a losing battle for banks other than the Federal Reserve. If you're raising rates by a significant amount simply to defend the currency, only to weaken your economy, you're kind of stuck between a rock and a hard place.
Smells a little bit like an emerging market, doesn't it?
Yeah.
That's an EM-type feel to this scenario for these central banks. Futures down 1.5% on the S&P. On the Nasdaq, we're down by 1.7 from New York. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's this Fed hiking that's really set the stage for everything.
If the Fed goes 75, that's built into the market, and I think a fair amount of tightening is built into the market.
Services prices are going to be sticky, and it's going to be very, very hard for the Fed to switch to cutting mode.
I think what the market's looking for here is for inflation to stabilize a bit.
If inflation goes from 8 to 7, that's not a victory lap.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. The end of a second quarter to forget about. We will look forward here in this hour. The President of the United States from Madrid in this hour claims, John, and then in this hour, John, we need to recalibrate for the third quarter.
And take stock of the pain we've seen so far in the first and second quarter. Futures down again by 1.4%. And I think we got told yesterday what this is all about, Tom. It's about getting inflation down and keeping financial conditions tight. That's the Fed's goal. That's the objective. And if we heard from Mike Schumacher of Wells Fargo 1 hour ago, it's the line of the morning. It's a feature, not a bug. We're going to see more of it.
That is the script as we are right now, but we'll have to see what the market says about that and how the market adapts. John, what I see is dollar strength. We've talked a lot about the euro in the last hour, 103.94. John, EM over the last 9 years can't get out of its own way. Down 53% on the blended JP Morgan index.
And now DM is confronting EM problems, Tom.
Exactly.
That's the story this time around. What do you do when you have contradictory issues? When you have conflicting issues? When you have the issue of inflation that's too high and you need to get it down, and growth starts to weaken and you need to support it? Tom, you can't do both. You've got to pick. And right now they're choosing to do something about inflation.
In this hour, we're jargon-free. John Farrow, EM, folks, is emerging market, and the other idea is developing market, DM, as well. John, all that matters is USD. That's U.S. dollar. What did Jerome Powell say yesterday?
When did you start to define everything? When did this begin? When did this start? Is this a new day?
I got an email.
What's going on here?
I got an email
what is
here
this?
from Al from New Jersey. What is Farrow talking about?
He wants to strip back the jargon from the program.
Yeah, well,
okay.
We're not going to do that. We're not going to lose the jargon.
We're not, okay.
We have Seema Shah coming up. We can't lose the jargon. Lisa, I'm looking at the president has to address domestic. Somehow, maybe the R word won't come up, but the I word will.
Yeah, and the I word is what's redefining the entire market situation right now. We are ending a historic half of a year, a historic 6 months, not only in the pace of the declines, but also this reframing that we heard yesterday from central bankers, where their reaction function is going to be entirely different, Tom, in combating the I word, inflation, and not necessarily financial conditions. It's a game changer that's creating a lot of gloom out there.
And John, critical, we got to do the data check here. I need to start, John, with the spread market.
And
I'll look at the Amalfi German spread, and it says here it's wider.
Is that what
Some
we're calling
fragility within Italy today.
Okay, you're on rare form today, aren't you? Yields are in 6 basis points on a 10-year, 3.0296% on a US 10-year. Your FX market looks like this. Tom's been keeping you up to speed on that. Dollar strength, with the exception of the Japanese yen through G10. Euro dollar, very briefly, looking at 103.80 again, 103.94 right now, down 0.5%. And crude backing off as well, Tom, 108.50, 108.45. We're down 1.2%.
Chief Global Strategist at Principal Global Investor, Seema Shah, joins us right now. Seema, you wrote a mid-year report 5 days ago. What's changed in the last 5 days? What is the new staggering into Q3?
Hi, John. Hi, Tom. Thanks for having me on. Look, I don't know what's necessarily changed. I think all that we've seen is that central bankers are finally being a little bit upfront about what they're actually having to deal with, and they've finally emphasized, especially for the Fed, that they finally emphasized that price stability has to be their #1 priority. And I think for markets, that's given a bit of a wake-up call. This is not going to be an easy ride. If anyone thinks that equities can rally to the back of the year, they're making the assumption that the Fed is going to let go of its entire focus on price stability and step back from that. And we have a very different view. We think things are going to get pretty tough.
Seema, that's another way of saying they are not going to tolerate an easing of financial conditions. They're not going to tolerate a rallying equity market. They're not going to tolerate tightening credit spreads. So I want to understand from you just how much downside you think there is. Do you think of this as a moment where markets can't rally, or do you think of this as a moment where markets have to sell off more?
So it's interesting because when we look at technicals, if you look at just investor sentiment, it is getting extremely negative. There's been a fair amount of flows into cash as well, which means that I think we could see a bit of a technical rally over the next couple of months, assuming that there are no negative, or I should say positive upside prints on the inflation side. But that doesn't mean that that is a sustained rally which is going to continue into 2023 by any means. We think that as soon as you start to see your second leg of the downturn, which is essentially when earnings growth starts to come down, that is when you get your a further drop in equity market declines. How far we go from here is a difficult one to call. I think you could get another 10 to 15% drop from this point, but between now and then, you could get a bit of a rally.
If we were doing a full-on jargon hour, we would be talking about a soft recession, which possibly is the biggest cliche of the moment, as we talk about how much this contours of this particular recession will be different than those of 2008 or 2009. Do you agree with this assessment, that it's going to be shallow, that it's not going to be as painful as previous downturns?
I do, and I think the reason is that when you think about the GFC, that was so much imbalance that had to be worked through the economy, and that dragged it out for quite a long time, and also made it pretty deep. I think from our perspective, we can see that this is going to be a shallow recession, but almost the more difficult part is that once we start to see the Fed cut rates in response to recession and inflation fears coming down, how far do they really go? Do they go back to the 0% level that we've become so accustomed to? Or do they start to settle it just below the neutral rate, which is around 2%? So I agree that this is a more inflationary period going forward for the next 10, 20 years. And monetary policy is going to have to follow with that.
So, Seema, how does that reshape your thesis in terms of how to arrange some of your assets? I'm thinking particularly of 60-40 that just had its worst quarter ever.
Yeah, well, I think this really plays into the idea that it's real assets, right? We're looking at not just a medium or a short-term inflationary period. This is a medium-term inflation outlook where commodities infrastructure can really continue to outperform. From a bond side, well, look, I think we can still be thinking about higher quality and moving into slightly longer duration. But unfortunately, the longer duration doesn't work for too long because we just don't see U.S. Treasury yields falling too far if you start to think that even in a recession, the Fed isn't going to cut all the way to zero.
I had a couple of messages this morning from a terminal subscriber, and he talked about the consensus that we've gone over 1 million times and how quickly that consensus has changed. This is what he said. I think the market call was this. The Fed won't hike much in 23. The Fed won't hike 50. The Fed won't hike 75. Inflation peaked in March. Fed will pause in September. Inflation will come down in the fall. The Fed will pause in early 23. No recession, no recession. 25% recession risk, 50% recession risk. And now seemingly, Tom, the new one, and this is not me throwing shade at Seema, because Seema, I'll give you the chance to respond to this, but the new consensus view is recession but a shallow one. And we've heard that several times this morning. In fact, we've heard it a lot of times this week.
John, you're killing me.
Well, give me something, Tom.
Magnitude. I would look within all the discussion here of Y equals C plus I plus G plus NX, the international component, the trade component. It's about gaming the magnitude of a slowdown. John Williams, New York Fed, says there's not going to be a recession. We're going to get that growthy agony of a more subdued positive statistic.
1 to 1.5 is what I think he said. Seema, I wanted to give you the chance to respond to that because it started to become this consensus view. Recession maybe, but a shallow one. You comfortable with that a lot of other people just see it the same way, but we've had that story a few times this year and it's changed pretty quickly?
Look, I think that investors, just as central banks, have been caught out many times in terms of the inflation view. And, through all of this, energy and food inflation are going to be the wild cards. That is going to be difficult to predict. I think from the recession perspective, because we just fundamentally don't have major imbalances in the system, it's difficult to see it getting to the GFC perspective, unless this is a caveat, which is where you get commodities continuing to rise, hitting that $150 a barrel. And then you're looking at stagflationary shock, which in that case, that's a deeper recession and it's a longer recession. But that's the wild card.
Seema, thank you for that explanation at the end there too. Thank you very much. Seema Shah there of Principal Global Investors. Lisa, just on some of the challenges of the consensus view so far this year.
One of the big question marks that I have leading up to some of this consensus is people say it's not a very leveraged cycle, that the consumers are not over-leveraged, that banks are not over-leveraged, that yes, there's money in the system, and yes, that companies have borrowed, but it's all very appropriate. What is the reset pain of dealing with companies that financed at a 5% rate versus a 10% rate now? That, to me, is a huge question mark. If this type of environment persists for long enough, you will have real pain at the corporate level when you deal with the new financing regime of an inflationary environment. And that, I think, is something that is very difficult to game out.
Are you thinking of vacations on boats, cruise liners?
Going
Specifically,
to zero?
Is that what you were thinking of?
Well, I mean, I personally wasn't, advertising that, but I am thinking of Carnival. Yeah, that they borrowed money at 5%, at 6%, not that long after the pandemic because of the free money from the Fed. And now people are speculating that their equity could go to zero. I mean, how much has the scene changed overnight, and how many more carnivals are there?
Well, okay, we're going to head for New Orleans for Carnival. We're looking forward to that as well. John, what this reminds me of is we need to consider from a central bank standpoint the Bramo put.
The Bramo put.
The Bramo put is different, and it's more nuanced. It has to, you fold in a little bit of spread market and jargon and debt in there.
That works.
The Bramo put is important. John, thank you so much, folks. John and I really appreciate the emails, the Twitter feed, particularly to Lisa, far more popular than we'll ever be.
Much more loved.
Yeah, much more loved. There's no question
Let's
about it.
put it that way.
John, we're taking in the strategic end of quarter lunch for team surveillance at McDonald's on 3rd Avenue. That's what we're springing for this quarter. We're trying to tighten up a little bit here. Al from New Jersey emails in. He's looking for an all-cliche surveillance to move into Q3.
Nice. Dictionary Corner with Tom Keane. That's going to work for me.
That'll be good.
I'm looking forward to
I'll
that.
check my
You going on a cruise, Bramo, tomorrow?
No, I'm not going on a cruise.
Just checking.
I'm going to probably end up in the Detroit airport based on my luck.
Wondering if you're doing some market research. What's wrong with Detroit?
Nothing is wrong with Detroit.
Why'd you say you won't be unlucky about being there?
I think it's fabulous. Really?
Yeah.
God, she's doing the Home Alone imitation at O'Hare.
I think we're out of time.
We're down 1.4% on the S&P. Bramo's got things to say. Just wanted to give her time to talk about it.
Let's go.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Pfizer has asked U.S. regulators to let it expand the use of its COVID drug Paxlovid. The drug is now used on an emergency basis. Pfizer wants to now use it to treat people at high risk of developing severe disease. It's an oral antiviral treatment for people with mild to moderate COVID. China's Xi Jinping has made his first trip outside the mainland in almost 900 days. She traveled to Hong Kong, calling the city reborn since he last visited 5 years ago. His comments were an apparent reference to the sweeping security law Beijing imposed back in 2020 that crushed dissent. Xi is marking the 25th anniversary of Chinese rule in the former British colony. Vladimir Putin reacted to NATO's decision to admit Finland and Sweden by saying they're welcome to join. The Russian president said that NATO, including the Nordic nations, is totally different compared to potentially allowing Ukraine to join. Putin also said that if NATO places military personnel and infrastructure in Finland and Sweden, Russia will have to respond. Congresswoman Liz Cheney has warned her fellow Republicans that they must choose between former President Trump or the Constitution. She says they cannot be loyal to both. In a speech in California, Cheney called the former president a domestic threat the country has never faced before. Cheney is vice chair of the committee that is investigating the attack on the Capitol. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Boston Pop's Fireworks Spectacular is back in Boston, and Bloomberg will make sure you don't miss a second of the fireworks. Music and special appearances by superstar Shaka Khan, Grammy and Tony winner Heather Headley, and The Voice winner Javier Colon, plus Middlesex Fifes and Drums and the Tanglewood Festival Chorus. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
Reaffirming what you've heard so many times, but in a much more forceful way, from Chairman Powell of the Federal Reserve. It's Sintra Portugal alongside President Lagarde and Governor Bailey, together with Francine Lacqua of Bloomberg. Just a brilliant panel yesterday morning. If you can rewatch it, I suggest you do so. Right now, futures negative 1.4% on the S&P 500, on the Nasdaq 100 negative 2. We're down and down hard by 1.6%. Euro dollar negative 0.5%. 103.80, the closing low of the year. We're very close to those levels. 103.86 TK. Some real dollar strength out there right now.
Real quick, John, you give no love to Dr. Carstens. I thought his BIS annual report was important. He said there is no respite for the global economy.
I will give love to Dr. Carstens right now. Love to Dr. Carstens.
Okay, what we're going to do right now, John, help me here. We're waiting for the President of the United States in Madrid. We're going to see how that goes here onto the 8:30 moment, where we do have some economic data, but right now Michael McKee with us as well. Michael, I got to rip up the script to go to what we heard from Chairman Powell moments ago, and this goes back to the wonderful Neil Sauce at Credit Suisse years ago. Neil Sauce would pound the table on asymmetric outcomes. The third rail of Jerome Powell and all the PhDs around him is there's an asymmetry and a much bigger risk if they're wrong on inflation.
Well, that's the argument the Fed is making, and that's the argument that, to an extent, Christine Lagarde is making, although they weren't around in the 1970s, the ECB. But you look back at historical inflation, and you see when it started rising in the 1960s, and it wasn't till the mid-70s that it started to come down. You ended up with about 14 years of extraordinarily elevated inflation, and that just eats away at incomes and at living standards, and the Fed does not want to repeat that. Every central banker, it's like the Stephen King novel for central bankers. I mean, it's the thing that keeps them up at night and terrified. So they're going to, I mean, you read between the lines what it means. They're going to go hard on trying to bring down inflation. They'll raise rates.
Seats at Fenway were about 10 rows in front of me. He used to sit down right next to Peter Lynch, and the thing that frightened Stephen King was the middle relief for the Boston Red Sox. How does Jerome Powell act? It's 7% inflation, call it 8 to 7, versus going from 5 to 4. Those are two different worlds for him.
Those will probably be two different worlds, and they did talk in the session yesterday about the idea that we will see a slower return to a lower rate, but they need to keep going to that lower rate. They could adjust their rate levels because they know they can come down relatively quickly to maybe the 5 or 4% range, but it's going to take a while to get it back down to 2%. Now, I've talked to a number of Fed officials in recent days who say, we've got to get to 2%. We can't live with 3 or 4 because we promised 2. And if we live with 3 or 4, then people aren't going to trust us anymore.
Mike, it's hard to make the argument that one is data dependent when you're not sure which data to look at. You're not sure the accuracy of that data, which brings me to the ADP jobs report, which every month we discount as completely inaccurate and something you're going to trade on is going to be completely irrelevant when it comes to the jobs report that you get 2 days later. They are now suspending it for 2 months to rejigger the inputs. Do we understand what has gone wrong with this particular metric?
Well, not exactly. The ADP originally was a look at the number of people who were on ADP's payroll. They do data processing payrolls for thousands of companies, and that didn't work. So they retooled it, and they put in some additional mathematics that included the jobless claims numbers, and that improved the number somewhat, but as we've seen, particularly in recent months, the ADP numbers come in often way off of where the Labor Department numbers are, and so they're trying to figure out how they can make it more accurate. It is something that's traded on every week and sometimes influences economists' views, but it is not something that is an accurate predictor of what the jobs level is going to be.
I've got to say, I'm looking forward to the ISM tomorrow, Lisa, particularly after the PMIs we've had and the deceleration we've seen. And as well, what we've also seen, Mike, and I'd love your view on this, some of the regional Fed indicators have been pretty dreadful. The Dallas Fed, the Richmond Fed. I just wonder, Mike, from your perspective, how much weight you would put on some of those readings.
Well, it's the kind of thing that makes you raise your eyebrows and makes you want to look more deeply into the situation with manufacturing in the country. ISM doesn't usually reflect change in any one of those particular regional numbers, but if they're all going down, then that may tell you something about what's happening. They aren't as statistically valid or as old as the ISM number, but the ISM is going to reflect some problems as well. We saw it go down last month. It's just a question of, does it go into negative territory? And we'll also want to see the price index for ISM, and we'll want to see the employment index for ISM, because we're getting to this point now where every data point matters.
Mike McKee, thank you, buddy. That data point, more data points coming up in about 6 minutes' time. You won't hear from ADP for quite a while, and I imagine Mike McKee might be included in this. Some of you will welcome that for the next few months or so. Over in Madrid, Spain, I can tell you things settling down, and that room is getting ready for a news conference with the President of the United States. High-level talks for the President over the last week or so. Tom, on the international stage, he spent time in Bavaria, Germany for the G7 before he made his way to Madrid, Spain for a meeting of NATO leaders. And before he departs, we will hear from the President of the United States.
Well, we'll hear from the President of the United States. We're not going to hear from the President of Italy. Mario Draghi, I believe, has already left, John, and he goes back to $8 a gallon gasoline in Rome and in Italy. They're all going home to only one issue, away from the horror of the war.
And part of that discussion that they're having on the international stage, Tom, influences the domestic pressure at home. The Italian Prime Minister going home to what the American President will have to go home to Lisa, and for that matter, the German Chancellor and the French leader.
Yeah, and how much does that inflation backdrop really feed into some of the social unrest? I mean, there are nuances to the other issues that Joe Biden is coming home to, particularly with the Supreme Court and what's going on there with some decisions coming through. But how much support does he have heading into the second half of his term to actually make a difference, given some of the disagreements? And we really have seen that in force over the past couple of weeks.
Yeah, I'd have to add to that, Lisa, given the proximity of some of the European leaders to the issues on the border, going into Ukraine and over to Russia, Tom, they've got a much, much stickier path through 2022.
Yeah.
Is your mic down, Tom? Just not participating anymore?
I'm sorry. I thought you were going to Lisa on that. I was looking to see where President Biden is, and I guess we're waiting for him on through past.
It's good to have you back with us on the show.
Well, I was reading.
Thanks for participating.
I was writing a memo on jargon.
I'm sure you were. When the president takes the stage, we'll bring you that news conference. He should be taking the stage very, very shortly. The president of the United States and a news conference from a NATO summit in Madrid, Spain, earlier this week. From New York City, this is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
McKee in the building, which means one thing, economic data just around the corner, seconds away, going into it. Equity futures off session lows, but still negative. We're down 1.3% on the S&P. On the Nasdaq 100, we are down by 1.6 with some economic data for you. Let's cross over to Mike McKee as we wait for some of this to drip out. Morning, Mike.
Drip out is the word. Let's start with initial jobless claims. It's another move higher. Got to see what the revision is to last month, but we're up by 2,000. Not a whole lot, not a big change, but 231,000 jobless claims, initial jobless claims for the week ending June 25th. Now, the income and spending numbers is what everybody's been waiting for because they have the PCE inflation figures. And on a month-over-month basis, we're up 0.6, which is much higher than the 0.2 from last month. Leaves the deflator at 6.3% on a year-over-year basis, which I suppose is probably good news for the administration and for the Federal Reserve. On a month-over-month basis, core is up 0.3. That is the same as last month, and that drops, given base effects, the year-over-year number to 4.7% from 4.9%. Now, this is the kind of thing that had been expected because the base effects were involved and because we're getting a wedge now between the core rate and the headline rate because the headline rate is much more influenced by energy prices. And the problem for the Fed is that energy prices have come down significantly, but if they go back up again, they can't do anything about it. They have to sort of focus on the core to get a good idea of where inflation is, but their favorite indicator on a core basis is a little bit better. Just scrolling through the data here, and I want to point out incomes were up 0.5%, spending up 0.2, and that's after a 0.6 gain the month before, which was revised down from 0.9. So maybe taking some of the inflation out of what people had been spending. The news on income better than forecast. It's the same as last month at 0.5%. Spending on an inflation-adjusted basis down 0.4 compared to a 0.3 gain in April. So we are seeing inflation affect the spending numbers, and I would imagine there's a bit of inflation in the income numbers as well.
Mike, I'm going to borrow that phrase you used a little bit earlier, just about a minute ago, a little bit better. So the market a little bit better. Equity futures off the lows were down 1% on the S&P 500. What you saw in yields is just starting to roll over just a little bit more, down 6 basis points to 3.02%. And that dollar strength is still there, but that fades too. Euro dollar goes from a 103.80, 103.90-ish, back to a 104, Tom. That currency pair negative a third of 1%.
Maybe inconsequential, but maybe not, because we have to sum it together with all the other data. John, as you mentioned, yesterday or the day before, the data's been really soggy. And is this soggy data? No, I don't want to be that gloomy, but you know, you saw yields move in 7-8 basis points. Maybe now they're only in 7 basis points. I'm going to watch the 10-year yield. If that breaches 3%, that gets my attention. It hasn't done that yet.
Not far off it, Tom, a couple of basis points away. And Mike, a lot of this, I think, for me, sets the stage. As I was looking ahead to this week, just going through the schedule, you did a great job of that at the start of the week for us. The ISM was the one that just sat there going into the long weekend that I think we're all focused on. And Mike, I'd love to know what you're looking for going into that.
Well, I think we're going to probably see a bit of a decline in the overall headline number, given what we were talking about earlier. All the regional indexes show a decline. It'll be interesting to see what the prices paid numbers are, because some of these headline energy numbers and other commodity prices have dropped over the last month. So we'll see if prices paid comes down, and that would probably be seen as good news. Anytime the Fed is looking at core, but anytime you get a drop in the headline rate, it's good news for the Fed, because it pushes back in people's minds the idea that inflation is going to get over-entrenched in the economy. I was just looking at the numbers here for personal income and spending. Disposable personal income up 0.5. So not a major impact, it looks like, on a month-over-month basis on what you get after taxes. So a reasonable figure there.
Mike, thank you. More data still to come this week. That's all behind us. Looking ahead to ISM tomorrow morning at 10 a.m. Eastern Time. Right now, Tom, futures down 1.1%.
We're going to squeeze in Stephen Stanley here with Amherst Pierpont as we wait for the President of the United States in Madrid. Steve Stanley just doing fabulous work on the makeup of the American economy with Amherst Pierpont. What's your biggest mystery into Q3, Steve Stanley, and the classic equation, consumption, investment, government, or trade dynamics? Which one is the great Stanley mystery?
Well, I think you got to watch the consumer and you got to watch housing, because the markets are starting to smell economic slowdown, which I think is a little premature, but certainly that is the issue of the day. And if we're going to get a slowdown, that's where you're going to see it. So we've been focused very keenly, I think, over the last couple of months on housing, and it does seem to be cooling off, but it's cooling from a very hot temperature. And these numbers today on the consumer are a little disappointing. So I do think that the consumer is going to have a big summer, people getting out and doing all the things they haven't been able to do for the last couple of years. But the data this morning are not all that encouraging.
And Stephen, that's exactly where I wanted to go, especially because real spending declined for the first time going back to December, and more than people had previously expected. This is inflation-adjusted actual spending. How quickly is the consumer, based on this data and other incremental points that we're looking at, how quickly is the consumer rolling over in terms of their ability to really accept some of the price increases?
So, well, there's ability and willingness, right? And I think the ability is unusually strong because consumers are sitting on a huge pile of cash that accumulated during the pandemic, you know, all the fiscal largesse in particular. So consumers have the wherewithal, at least in the aggregate, to spend. I mean, obviously, inflation is going to create stress for certain households, but there is a question about willingness. And I think given the consumer confidence data, you have to wonder a little bit about how eager consumers are going to be to continue to spend. My sense is that they're still very enthusiastic. Certainly, any field trip to the airport would suggest that people are still looking to get out.
Lisa, you're going to have a field trip to the airport tomorrow,
and it's going to be a nightmare. I'm already prepared for this. Flights are getting canceled. How much, though, is this part of the story? That it is a blip, it is revenge travel, it is people who are reprising the past that they were not able to live during the pandemic. That ends. It ends with the miserable experiences that people have in the airport. It ends with the fact that people have gone out, they've traveled, they're now exhausted and are ready to start whatever it is that is the post-pandemic reality. How much is this the last hurrah when it comes to travel and some of these inputs that leads to the next phase that begins at Labor Day?
Right. Well, there's definitely, it seems like there's going to be some catch up. So that's the short run burst, if you will, in the economy. And I think that does certainly protect any threat of a downturn in the near term. But as you say, I mean, once you get past that, then it gets back to the usual fundamentals. I mean, certainly one thing that is on the positive side is the labor market, and you know, the unemployment rate around 3.5%. So people have jobs, and incomes are not necessarily keeping up with inflation the way we might like. But income growth has been pretty strong, and I think sufficient to support ongoing growth in consumption. So. I take your point, but I think that the underlying fundamentals are still pretty good. I think what we really have to see is how sensitive is the economy to higher interest rates. We haven't had higher interest rates for a very long time, certainly going back before the financial crisis, and it remains to be seen how sensitive the economy is as interest rates rise, and I think housing is going to be the test case there. So that, again, is why I'm keeping a
Stephen, when this conversation often comes up, I often hear economists describe the aggregate story, the headline stuff. Can you break it down a little bit more for us? What the low-income groups, middle-income groups, high-income groups, what you expect from them this year? Because from an equity market perspective, that's going to have different consequences, different outcomes, ramifications for different companies.
Sure. Yeah. Well, if you go through the pandemic period and think about that accumulation in household balance sheets, there were really two stories. For the wealthier households, they weren't getting a lot of the fiscal largesse, but they were benefiting from the markets, in particular the equity market, but also housing. And then the people with more modest incomes were the ones that, for the most part, who were receiving the rebate checks and the unemployment supplemental unemployment benefits and things like that. So even the folks at the lower end of the spectrum came out of the pandemic, perhaps a lot of them at least, in better shape than they might have been otherwise. Of course, you know, over time that cushion will get spent, and in particular in this environment, inflation will erode the purchasing power to a degree. So it's going to be important for the labor market to stay strong. Those folks at the lower end of the wage spectrum have been doing particularly well in terms of wage gains, and you'd like to see that continue.
You would. Stephen, thank you. Stephen Stanley there of Amherst Pierpont on the challenge to the consumer, issues we've all got to think about when it comes to markets and this economy. We were expecting to hear from the President of the United States at 8 a.m. Eastern Time, so about 40 minutes ago. I should rephrase that. We were scheduled to hear from the President of the United States at 8 a.m. Eastern Time, though I think most of us expected that we wouldn't hear from him then because it would be delayed, and it has been delayed. We're about 40 minutes delayed, Tom, and no real sign of that beginning just yet. A lot of people seated. We're ready to go. When it starts, of course, we'll bring it to you.
I thought Steve Stanley was brilliant there, and of course, that's the kind of report that President Biden would like to hear. And we need to re-emphasize, John, there's a whole school of thought of optimism. Not that this time is different, but just the gloom is on a magnitude basis off the mark.
Just on the gloom of flying, I hear from Delta, Bramo, that you can change your flight for free this weekend on July 4th weekend. Now, I take issue with that because if they want us to change our flights, shouldn't they subsidize that effort? Shouldn't they be incentivizing it? And saying you can do it for no cost when you probably want to go away on the July 4th weekend anyway, that doesn't really work for me.
Well, we'll see whether anyone takes them up on that. We'll see whether they have to actually pay up in order to do that, because you have to use that ticket before July 8th. And yes, I saw this, and yes,
ridiculous.
I got nervous.
That's
and
ridiculous.
I know, because you have to then change your plans, and it basically is, if perhaps you have flexibility in all of your plans, then it's fine with you because
that's
you
not
want
how
to
life
avoid the
works.
mess. Well, let's see what happens.
Will you take a camera to the airport with you tomorrow? Do a live blog.
Do you really want pictures?
I'd love that.
And do you want a live narration too?
I'd love
Just
that.
gritting teeth.
Bramo unhinged.
It's the miserable experience of Bramo
Cursing
travel.
at the airport. I think it'd be great.
John,
great
Bramo
television.
travel is
Oh, dear Lord.
The bear X-rated, cursing and everything. Be awesome. Futures are down on the S&P in the next hour. If the president doesn't interrupt it, we will hear from Jonathan Golub of Credit Suisse, Anastasia Amoroso of iCapital Network, and David Costin of Goldman Sachs. Looking forward to that. And of course, the president will be our priority. We're waiting for him to speak any moment now from Madrid, Spain, after the NATO meeting wraps up. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Delegates say that OPEC and its allies have ratified the planned increase in oil supplies for August. The agreement calls for 648,000 barrels a day more. But in the past, not all of the increases have materialized. Oil consumers have been clamoring for more OPEC plus supplies for a while now. It will be a historic day at the U.S. Supreme Court. Ketanji Brown Jackson will be sworn in as the first black female justice on the court. Jackson was confirmed to replace Stephen Breyer in April, but she then had to wait until he stepped down at the end of the 9-month term. Jackson is likely to join fellow Democratic appointees Sonia Sotomayor and Elena Kagan in the court's liberal wing. In France, inflation has accelerated to the fastest pace since the euro was introduced. Higher increases in energy and food costs drove consumer prices growth to 6.5% in June. That will give more justification for the European Central Bank's plan to lift interest rates next month for the first time in what would be more than a decade. Israel is now facing its 5th election in just 4 years. The fragile governing coalition led by Prime Minister Naftali Bennett was collapsed, setting the stage for an election November the 1st. The end of the coalition could present an opportunity for former Prime Minister Benjamin Netanyahu to return to power. His Likud party is leading in the polls. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed goes 75, that's built into the market, and I think a fair amount of tightening is built into the market. If Loretta Mester gets her 4% next year, then I think that we're seeing an inverted yield curve, all else being equal.
Kathy Jones of Charles Schwab, she and Liz Ann Saunders have just been on fire in reporting where we are right now. Certainly what we've heard this morning is a differences of opinion, the heated debate of this June 30. Lisa Bramwitz and Tom Keene, John, preparing for a 9 a.m. effort. We are preparing to hear from the President of the United States in Madrid. We'll bring that to you as we see really all of America waiting to hear his comments on the history of what we saw at NATO and, of course, on his return to an 8% inflation in America. Right now, we're going to try to squeeze in a chart with Kriti Gupta. Kriti, what do you have?
Tom, let's do it. I'm going to bring back a little bit of some of the pre-war issues that we were seeing, those surging shipping rates. And that brings me to my chart today. We just got that PCE data, and perhaps still accelerating, but less than what, by a margin less than what we expected. But this is what I want to bring. There's the pre-war inflation, and then there's the post-war inflation, the commodity inflation we're so used to talking about. But check out the shipping rates, for example. A lot of the issues that we had with supply chains really came down to these shipping rates. Essentially, my chart of the day shows the cost that it took to transport a 40-foot container from Shanghai to LA. And for our radio audience, it's this massive surge that's actually coming down from its peak. Yeah, it's rolled over. And this is interesting because this is really perhaps one of the positives, I should say, and I say this with a massive grain of salt, of that inventory buildup. If you have a massive inventory, you're not suddenly clamoring for more supply, clamoring for more exports, especially in light of that COVID lockdown policy. In fact, that demand is going to come down just a little bit. And right now, that's exactly what we're seeing, a little bit of a slowdown when it comes to those shipping rates, Tom.
Kriti, thank you so much. Again, waiting for the President of the United States, really, we think momentarily. Barry Rittenhold's joining us now. We may have to cut him off to go to Madrid. But within his wonderful book, Bailout Nation, is what a president can do about inflation. We go to Rittenhold's because he's the only one I know that still has his Gerald Ford whip inflation now button. Yeah, that worked out, Barry. What can a president do about inflation?
You know, you're asking the question after the fact. It's what presidents can do that leads to inflation that they need to avoid doing. And it was pretty clear that not only was the CARES Act 1 and 2 an immense fiscal stimulus, the first CARES Act was 10% of GDP. It was just a record. CARES Act 3 under Biden added that much more fuel to the fire. So that's one of many factors. Fiscal is just part of the problem. Once the genie's out of the bottle, it becomes a whole lot more difficult to get things under control. I give a little bit of credit to this administration for trying to work on things like Medicaid reform and prescription drugs, but that's really just a small portion of the total inflation picture. Energy, food, those are the big factors now, and that's out of the president's hands.
Barry, what do you say on a mid-year review of someone's portfolio? And folks, Mr. Ritholtz lives this every day. And bonds are down 15%, 12%, 8%, whatever. And equities are down, let's call it a Ritholtzian 10%. What do you actually say to be steadfast in your optimism?
You know, this is a feature, not a bug. You don't get upside without downside. If markets only went up, if there was no drawdowns, corrections, bear market crashes, hey, we'd all be wealthy, and it just doesn't work that way. In order to get to the promised land, whether that's decades down the road or just a couple of years down the road, your behavior matters more than anything else. You could have the world's greatest portfolio, but if it keeps you up at night to the point where you're just sick and eventually you capitulate and sell at the worst moment, you're going to do very poorly. The best portfolio in the world is the one that perhaps gives up a little bit of performance, but allows you to sleep at night. And this is just the cost of admission. There's no way around it if you're an investor.
Barry, how does the nature of sleeping at night change when you have a sea change when it comes to a Fed policy and a Fed response mechanism? That is what we heard yesterday, which capped off a historic half of a year where we basically saw bonds and stocks fall in tandem. And now we have central bankers around the world saying we are probably never going to go back, at least in the near term, to that low inflation environment. How do you change the construction of your portfolio?
So you have to put all your money into the Fed Contra Fund, which has outperformed the market by, oh, wait, that doesn't exist.
Barry, be careful.
The Federal Reserve.
Barry, I love that.
Nobody has figured this out.
Barry, be careful here. You're going to have three firms come out with the Fed Contra Fund.
You have to ride it out. If, you know, every time we have the discussion about, I want to get out of equity for X number of months, then get back in, okay, good luck with that. History shows us that about a third of people who try to do that never return to the market. So,
but Barry,
you know, you could look at this. You could look at Here's what the Fed, now, by the way, we could get together for dinner and talk about what the Fed is doing wrong and how they were behind the curve in inflation, and now they're probably overreacting. I think the market anticipating a 75 basis, another increase. At that point, I move into the recession camp. So they were behind at one point, and now they're probably overreacting. But, it rains, and it's nothing you could do about it.
Understood. And this is sort of the trading argument where you have to stick to your guns and have some sort of strategy. But the strategy changes when you talk about rates not being in a bond bull market. If you're saying this has been the death of it, we watched it over the past 2 years. We watched this entire cycle break down, and now you are having central banks telling us it's over and that they are not going to hold your hand. They don't have the ammunition to do that because inflation is their priority, and they're going to go hard at it. How does that change the 60-40 mentality, the idea of bonds as a ballast and really a profit driver that helps you sleep at night when you've lost more than 12% in benchmark bonds?
All right, so I'll give you a very, very specific question based on what we actually did. Earlier this year, we looked at the risk assessment of various treasuries. We're long tips, they're doing fine. Anybody who's long treasury inflation protected securities, those bonds are doing fine. But when we looked at what we were getting paid for taking the risk of duration, the yield was the same in the beginning of the year for 7- and 10-year bonds as they were for 3- and 5-year bonds. So what makes sense as a strategy is shortening up your duration, not because you're forecasting the direction of interest rates, but if you're getting paid the effectively the same exact yield for tying up money for 3, 5, and 7 years, well, then take the 3-year.
Barry, stay with us here. Let me do a data check here. We're with Barry Ritholtz, of course, with all of his good work with Bloomberg Opinion and his wonderful podcast for Bloomberg. Hugely, hugely successful, I should point out. And we're also waiting for a successful press conference from the President of the United States, scheduled to make comments. He is at the IFEMA building, a modern construction in Madrid. It is somewhat like a convention center. It held COP25 of climate change and, of course, these NATO meetings of NATO 2022, and very poignantly also had 5,000 beds during COVID. This was a hospital for Spain, like other nations in Europe, beleaguered by COVID. The data is moving here. Barry, I'm going to thank you right now because we're seeing what we're going to do in Madrid. Barry Ritholtz, thank you so much. And Lisa, we've got to notice a yield giveaway here. The 2-year yield down 9 basis points, 2.95%. And we are just a little bit of a tick away on 3% 10-year, aren't we?
Which is fascinating at a moment when people are looking for a higher yield that will curtail growth. Where is that higher yield going to happen? When do we see that inverted yield curve as the short end continues to go higher? And the longer end gets a bid from all of these investors seeing that as the sleep at night capital yet again. How long can we continue in that type of environment, Tom?
We'll have to see. Futures negative 46, Dow futures negative 400 earlier, now negative 342, and the VIX with a 30 print an hour ago. Ian Lingen out looking at maybe a more quiescent inflation tone than we see. And Bitcoin, I must admit, has had a very difficult day. Lisa, I don't know what to make of Bitcoin. I would suggest into 4th of July weekend where it trades 24/7. That's going to be a wow weekend for Bitcoin.
Bitcoin has been fascinating as a representation of what happens when you take the froth out of the market. And that seems to be what's going on. Just to give you a sense, from 47,000 to 19,000. That is what we saw this year in just a couple of months with Bitcoin.
I want to state here the backdrop for this President of the United States in a NATO that I've never envisioned. And I would suggest, folks, a NATO that Admiral James Stavridis never envisioned. 2 moments yesterday that Lisa, John, and I made note of and saw. For those on radio, the poignancy of the President of the United States sitting on his right and left with the leadership of Japan and South Korea speaking at a NATO meeting in private about China was absolutely extraordinary. And Lisa, not enough can be said about the true shock Finland and Sweden, and the headline 2 hours ago, may be joining NATO by Tuesday.
What a shock overall at the change in the NATO message from just a couple of years ago that Russia is not their adversary to Russia is clearly the adversary. We need to build up troops on the eastern border. And, oh, yeah, we need to come up with some plan to counter China's dominance in certain industries. How do they balance that out amid the backdrop that they come home to? We've been talking about it all week with the idea of inflation looming large, with a lot of distress among individuals. Very difficult moment, Tom.
We're going to have to see on that. On the president and on this travel, he will come home to any number of things, including a really critical labor report. John Farrell mentioning is it the ISM? I can never remember.
It's the manufacturing data that comes
July
out tomorrow.
1st, we're going to see that. Is Jobs Day tomorrow? I can't even remember, Lisa.
I think that Jobs Day is the week after.
The week afterwards is Jobs Day, and we'll have that for you. And that will be important to see if there's finally an erosion in the labor economy. We heard Jerome Powell in his testimony to the Senate of Joe Biden. The first sentence out of his mouth, Lisa, was simple. We have a strong economy. Steve Stanley just said that of Amherst Pierpont, and we'll have another guest on in 20 minutes who'll say, no, we don't. That's the debate.
And how much can that strong economy falter if you do have a Fed raising rates and if you do have consumers cutting back in the face of inflation? This is what President Biden will be addressing when it is impacting his ratings, when it is impacting his support at home and abroad.
And we'll have to see also into the midterms, of course, with those important elections the last number of days. And Kathy Hochul, of course, as governor of New York State for us here in New York, winning her primary effort as well. On the data front, I need to go to foreign exchange. Dollar ascendant. I would suggest if President Trump was on the podium, the first thing he'd mention is the dollar. The president walking out in Madrid here after his meetings, after the history made, here is the president of the United States.
Sit down. I think someone else walked in the room. Thank you very much for taking the time to be here. I think we can all agree that this has been a historic NATO summit. Some of the folks have been covering me for a while. About a year and a half ago, when the first G7 meeting took place in England, I talked about the need for us to reconsider the makeup of NATO, how it functioned, and come up with a different strategy for NATO and how we work together. And in addition to that, we also talked about the G7 taking on additional responsibilities. Before the war started, I told Putin that if he invaded Ukraine, NATO would not only get stronger, but would get more united. And we would see democracies in the world stand up and oppose his aggression and defend the rules-based order. And that's exactly what we're seeing today. This summit was about strengthening our alliance, meeting the challenges of our world as it is today, and the threats we're going to face in the future. The last time NATO drafted a new mission statement was 12 years ago. At that time, it characterized Russia as a partner, and it didn't even mention China. The world has changed a great deal since then, and NATO is changing as well. At this summit, we rallied our alliances to meet both the direct threats of Russia poses to Europe and the systemic challenges that China poses to a rules-based world order. And we've invited 2 new members to join NATO. It was a historic act. Finland and Sweden, 2 countries with a long tradition of neutrality and choosing to join NATO. Some of the American press will remember when I got a phone call from the leader of Finland saying, could he come and see me? And he came the next day and said, will you support my country joining NATO? We got on the telephone. He suggested we call the leader of Switzerland. Switzerland, my goodness, I'm getting really anxious here about expanding NATO. Sweden. And what happened was, we got her on the phone and she asked if she could come the next day to want to talk about joining NATO. Allies across the board are stepping up, increasing defense spending. A majority of them are on track for the first time to exceed our 2% of GDP commitment that they make. They agree to spend 2% of the GDP on defense. Look, for example, Germany is committed to spending 2% going forward and announced a special fund for its military of more than $100 billion. Slovakia, the Czech Republic, and the Netherlands have announced they will also meet their 2% commitments. Poland, Romania, Estonia, Latvia, Lithuania are doing more than 2.5%, some as high as 3%. Together, deploying more assets and capabilities to bolster our alliances across all domains: land, air, sea, cyber, and space. We've reaffirmed that our Article 5 commitment is sacred, and an attack on one is an attack on all, and we will defend every inch of NATO territory. Every inch of NATO territory. For our part, the United States is doing exactly what I said we would do if Putin invaded. Enhance our force posture in Europe. We'll station more ships here in Spain. We're stationing more air defense in Italy and Germany. More F-35s in the United Kingdom. And to strengthen our eastern flank, new permanent headquarters for the Army 5th Corps in Poland. In addition, an additional brigade combat team position in Romania. And additional rotational deployments in the Baltic countries. Things are changing to adapt to the world as we have it today. And all of this is against the backdrop of our response to Russia's aggression and to help Ukraine defend itself. The United States is rallying the world to stand with Ukraine. Allies and partners around the globe are making significant contributions. Secretary Austin just brought together more than 50 countries, pledging new commitments. And this is a global effort to support Ukraine. Nearly 140,000 anti-tank systems, more than 600 tanks, nearly 500 artillery systems, more than 600,000 rounds of artillery ammunition, as well as advanced multiple launch rocket systems, anti-ship systems, and air defense systems. And again, the United States is leading the way. We provided Ukraine with nearly $7 billion in security assistance since I took office. The next few days, we intend to announce more than $800 million more, including new advanced Western air defense systems for Ukraine, more artillery and ammunition, counter battery radars, additional ammunition for the HIMARS multiple launch rocket systems we've already given Ukraine, and more HIMARS coming from other countries as well. We also welcome for the first time our partners in the Indo-Pacific to participate in the NATO summit. As I indicated to Putin, his action would cause worldwide response. Bringing together democratic allies and partners from the Atlantic and the Pacific to focus on the challenges that matter to our future and to defend the rules-based order against the challenges, including from China. In the G7 in Germany, we also launched what started off to be the Build Back Better notion, but it's morphed into the Partnership for Global Infrastructure and Investment to offer developing and middle-income countries better options to meet their urgent infrastructure needs. Because when the United States and G7 countries put skin in the game, it helps bring millions of dollars up to, before it's all over, up to possibly $1 trillion of private sector money off the sidelines. $600 billion in just the next few years. Unlike China, these projects will be done transparently and with very high standards. For example, the U.S. government just facilitated a new partnership between two American firms and the government of Angola to invest $2 billion building a significant solar project in Angola. It's a partnership that will help Angola meet its climate goals and energy needs while creating new markets for American technologies and good jobs in Angola. As you heard me say before, when I think climate, I think jobs. And the G7 also said we'd work together to take on China's abusive and coercive trade practices and rid our supply chains of products made with forced labor. We task our teams to work on the details of the price cap on Russian oil to drive down Putin's revenues without hurting Americans and others at the gas pump. We'll seek to use the funds from the tariffs on Russian goods to help Ukraine rebuild. We've committed more than $4.5 billion, more than half of that from the United States, to address food insecurity and the immediate crisis caused by the Russian war. At every step of this trip, we set down a marker of unity, determination, and deep capabilities of the democratic nations of the world to do what need be done. Putin thought he could break the transatlantic alliance. He tried to weaken us. He expected our resolve to fracture, but he's getting exactly what he did not want. He wanted the Finlandization of NATO. He got the NATOization of Finland. Just think about this. That's what he thought. Now NATO and Sweden are closer than ever to joining, and this will occur. We're more united than ever. And with the addition of Finland and Sweden, we'll be stronger than ever. They have serious militaries, both of them. We're going to increase the NATO border by 800 miles along the Finnish-Russian border. Sweden is all in. The point is, we're meeting the goals I set out when the first G7 meeting. We're moving to a place that reflects the realities of the second quarter of the 21st century. And we're on the verge of making significant progress. Now I'd be happy to take your questions. And the first question, I'm told, is Darlene Superville from the Associated Press.
President. 2 questions, please.
Of course.
America is back was your motto at the first NATO summit last year, and you've come to this summit here and the one in Germany after the U.S. Supreme Court overturned constitutional protections for abortion, after the shootings in Buffalo and Texas, at a time of record inflation, and as new polling this week shows that 85% of the U.S. public thinks the country is going in the wrong direction. How do you explain this to those people who feel the country is going in the wrong direction, including some of the leaders you've been meeting with this week, who think that when you put all of this together, it amounts to an America that is going backward?
They do not think that. You haven't found one person, one world leader to say America's going backwards. America's better positioned to lead the world than we ever have been. We have the strongest economy in the world. Our inflation rates are lower than other nations in the world. The one thing that has been destabilizing is the outrageous behavior of the Supreme Court of the United States in overruling not only Roe v. Wade, but essentially challenging the right to privacy. We've been a leader in the world in terms of personal rights and privacy rights. And it is a mistake, in my view, for the Supreme Court to do what it did. But I have not seen anyone come up to me do anything other than, nor have you heard them say anything other than, thank you for America's leadership. You've changed the dynamic of NATO and the G7. So I can understand why the American people are frustrated because of what the Supreme Court did. I can understand why the American people are frustrated because of inflation. But inflation is higher in almost every other country. Prices at the pump are higher in almost every other country. We're better positioned to deal with this than anyone, but we have a way to go. And the Supreme Court, we have to change that decision by codifying Roe v. Wade.
There were some comments by some of your counterparts after the U.S. Supreme Court ruling. But my second question is, G7 leaders this week pledged to support Ukraine, quote, for as long as it takes. And I'm wondering if you would explain what that means to the American people, for as long as it takes. Does it mean indefinite support from the United States for Ukraine? Or will there come a time when you have to say to President Zelensky that the United States cannot support his country any longer? Thank you.
We are going to support Ukraine as long as it takes. Look at the impact that the war on Ukraine has had on Russia. They've had to renege on their national debt for the first time since the beginning, almost well over 100 years. They've lost 15 years of the gains they made in terms of their economy. They're in a situation where they're having trouble because of my imposition of dealing with what can be exported to Russia in terms of technology. They can't even, they're going to have trouble maintaining oil production because they don't have the technology to do it. They need American technology. And they're also in a similar situation in terms of their weapon systems and some of their military systems. So they're paying a very, very heavy price for this. And just today, Snake Island is now taken over by the Ukrainians. So we are going to stick with Ukraine, and all of the alliance are going to stick with Ukraine as long as it takes to, in fact, make sure that they are not defeated by Ukraine. I mean, excuse me, in Ukraine by Russia. And by the way, think of this: Ukraine has already dealt a severe blow to Russia. Russia, in fact, has already lost its international standing. Russia's in a position where the whole world's looking and saying, wait a minute, all this effort, you tried to take the whole country, you tried to take Kyiv, you lost, you've tried to take the Donbass and all of it, you haven't done that yet. The generic point is that we're supplying them with the capacity and the overwhelming courage they've demonstrated that, in fact, they can continue to resist the Russian aggression. And so I don't know how it's going to end, but it will not end with a Russian defeat of Ukraine in Ukraine. I'm supposed to go down the list here. Jim Tankers, the New York Times.
Mr. President, thank you. This week, you and the G7 allies introduced a plan for an oil price cap for Russian exports, which is not yet filled out, and obviously is a response to the high price of gasoline in the United States and around the world. Are you confident that that cap would bring down prices for American drivers? And how long is it fair to expect American drivers to continue to pay a premium because of this war?
Let me hear this. The second part of the question was, would it bring down the price?
Will it bring down prices? And the war has pushed prices up. They could go as high as $200 a barrel, some analysts think. How long is it fair to expect American drivers and drivers around the world to pay that premium for this war?
As long as it takes, so Russia cannot, in fact, defeat Ukraine and move beyond Ukraine. This is a critical position for the world. Here we are. Why do we have NATO? I told Putin that, in fact, if he were to move, we would move to strengthen NATO. We would move to strengthen NATO across the board. Look, let me explain the price. I suggested a while ago that what we should consider doing is putting a cap on the amount of money that we would pay the world would pay for Russian oil. And that we would not provide, the West provides insurance, would not insure Russian ships carrying oil. We would not provide insurance for them, so they would have great difficulty getting customers. The point is that we've said to them, here's the deal. We're going to allow you to have a profit on what you make, but not the exorbitant prices that you're charging for the oil now. We've delegated a group of our national security people to sit down and work out that mechanism. We think it can be done. We think it can be done, and it would drive down the price of oil, and it would drive down the price of gasoline as well. In addition, at home, I have also called for changes. I've released 1 million barrels of oil per day from our oil reserve, and in addition to getting other nations to move forward, a total of 240 million barrels of oil to release from the Strategic Petroleum Reserve, number one. Number two, I've asked Congress, would they in fact go and temporarily end the tax on gasoline at the pump? And thirdly, to ask the states to do the same thing. If we do these things, it's estimated we could bring down tomorrow, if Congress agreed and the states agreed, we could bring down the price of oil about $1 a gallon at the pump, in that range. And so we could have immediate relief in terms of the reduction of the elimination of temporary elimination of the gas tax. And so I think there's a lot of things we can do and we will do, but the bottom line is, ultimately, the reason why gas prices are up is because of Russia. Russia. The reason why the food crisis exists is because of Russia. Russia not allowing grain to get out of Ukraine. And so that's the way in which I think we should move, and I think it would have a positive impact on the price at the pump as well. Jordan Fabian, Bloomberg.
Thank you, Mr. President. Thank you, Mr. President. I also have two questions for you.
Of course.
Thanks. The first one is on Turkey. What assurances, if any, did you make to President Erdogan about his request for new F-16 jets for his military?
What I said back in December, as you recall. We should sell them the F-16 jets and modernize those jets as well. It's not in our interest not to do that. And I indicated to them that I've not changed my position at all since December. And there was no quid pro quo with that. It was just that we should sell. But I need congressional approval to be able to do that. And I think we can get that.
My second question is on your trip to Saudi Arabia, which is coming up next month. As we just discussed, Americans are paying almost $5 a gallon nationally on average for gas. So do you expect to ask the Crown Prince or the King to increase oil production? And if so, how will you balance that with your desire to hold them accountable for their human rights abuses?
Well, first of all, that's not the purpose of the trip. The purpose of the trip, first of all, I'm starting off on that trip in Israel. The Israelis believe it's really important that I make the trip. In addition to that, what we're trying to do is that the G7, it's the Gulf states plus 3. And so I'm sure that it's in Saudi Arabia, but it's not about Saudi Arabia. It's in Saudi Arabia. And so there's no commitment that is being made, or I'm not even sure. I guess I will see the King and the Crown Prince, but that's not the meeting I'm going to. They'll be part of a much larger meeting. And what we're talking about in dealing with that trip is that before I go, I'm, as I said, going to Israel to meet with the Israeli leaders to affirm the unbreakable bond Israel and the United States have. And part of the purpose is the trip to the Middle East is to deepen Israel's integration into the region, which I think we're going to be able to do, and which is a good for peace and good for Israeli security. And that's why Israel leaders have come out so strongly for my going to Saudi. But the overall piece here is we're also going to try to reduce the deaths and the war that's occurring. I mean, there's a whole range of things that go well beyond anything having to do with Saudi in particular.
But if you were to see the Crown Prince or the King, would you ask them to increase oil production?
No, I'm not going to ask. I'm going to ask. All the Gulf states are meeting. I've indicated to them that I thought they should be increasing oil production generically, not to the Saudis particularly. And I think I hope we see them in their own interest, concluding that makes sense to do. And, they have real concerns about what's going on in Iran and other places in terms of their security as well, all of them. Tarina, the Wall Street Journal.
Thank you, Mr. President. I'm going to keep the trend and also ask two questions, if that's okay. One on the summit and one domestic question. On the summit, you just said that there would be another round of security assistance for Ukraine. After hearing President Zelensky's assessment that the war needs to end before the winter, Are you changing your calculation in terms of the pace of the assistance and what kind of assistance you're sending to Ukraine?
No, the war could end tomorrow, by the way, if Russia stops its irrational behavior. So, you know, when the war will end, I hope it ends sooner than later. But for it to end, they have to be in a position where the Ukrainians have all that they can reasonably expect, we can reasonably expect to get to them in order to provide for their physical security and their defenses. And so one does not relate to the other. They need, we're going to be providing another, well, I guess I'll announce it shortly, but another $800 million in aid for additional weaponry, including, weapons, including air defense system, as well as offensive weapons. I have a whole list I'd be happy to give to you, but that's the next tranche that's going to occur.
And on the domestic question, sir, what further specific executive actions are you considering in response to the Roe ruling? And would you declare a public health emergency, as several Democrats are calling on you to do?
I'll be happy to go in detail with you on that. I'm having a meeting with a group of governors when I get home on Friday, and I'll have announcements to make then. But the first and foremost thing we should do is make it clear how outrageous this decision was and how much it impacts not just on women's right to choose, which is a critical piece, but on privacy generally. And so I'm going to be talking to the governors as to what actions they think I should be taking as well. And but the most important thing to be clear about is we have to change. I believe we have to codify Roe v. Wade in the law, and the way to do that is to make sure the Congress votes to do that. And if the filibuster gets in the way, it's like voting rights. It should be. We provide an exception for this. Require an exception to the filibuster for this action to deal with the Supreme Court decision. Hang on, I got one more here. Kelly O'Donnell, NBC.
Thank you, Mr. President. Well, you just made some news saying you would support changing the filibuster rules to codify abortion rights broadly across the country.
Right to privacy, not just abortion rights, but yes, abortion rights.
Can you describe for us, sir, many Americans are grappling with this. What is your sense today about the integrity and the impartiality of the Supreme Court? Should Americans have confidence in the court as an institution? And your views on abortion have evolved in your public life. Are you the best messenger to carry this forward when Democrats, many of them, many progressives, want you to do more?
Yeah, I am. I'm the President of the United States of America. That makes me the best messenger. And I really think that it's a serious problem that the court has thrust upon the United States, not just in terms of the right to choose, but in terms of the right to who you can marry, a whole range of issues relating to privacy. And I have written way back a number of law review articles about the 9th Amendment and the 14th Amendment and why the privacy is considered as part of a constitutional guarantee. And they've just wiped it all out. And so I'm the only president they got, and I feel extremely strongly that I'm going to do everything in my power, which I legally can do in terms of executive orders, as well as push the Congress and the public. The bottom line here is, if you care, if the polling data is correct, and you think this decision by the court was an outrage or a significant mistake, vote. Show up and vote. Vote in the off year and vote, vote, vote. That's how we'll change it. All right, guys. No, there's no such thing as a quick one. I'm out of here. Thank you all very much.
Concluding remarks from the President of the United States, wrapping up a busy week for President Biden on the international stage, from the G7 in Bavaria, Germany, to Madrid, Spain, for a meeting of NATO leaders. In the President's own words, the world has changed and NATO has changed as well, acknowledging problems abroad, influencing problems at home. Joining us now to discuss is iCapital's Anastasia Amoroso, Jonathan Golub, Credit Suisse. To the two of you, thank you for being so patient as we work our way through to the opening bell. As we listen to the president's remarks, futures are down by a little more than 1%. And Anastasia, I want to go straight to your mid-year outlook. It was a fantastic read, and go straight to your assessment on the consumer. It is no more reopening and travel chasing at all costs. You go on to say, no more revenge spending, no more excessive home goods buying as they face the sobering reality of higher costs. Has that consumer recession, Anastasia, for you, already started?
Well, John, we should clarify what we mean by a recession. And if you mean that it's several negative consecutive quarters of GDP growth, no, that is not my case. I don't think we have that negative outright growth. But I do think that the consumer slowdown is underway. And frankly, we've been talking about for months, this is going to be a consumer-led slowdown in the economy. So the good part about this, if you think about the last 2 years, it has been anything but normal. And we've built imbalances here and there. We've been built dislocations. So this is about coming back to normal. This is about coming back to prudence. And by the way, I don't think that's a bad thing for the economy, but it does mean that we're not going to grow 3 or 4% in terms of GDP. We're going to grow at 2% or probably even sub 2% as we progress to the end of the year. So that's just the reality. And as a market participant, you have to adjust to that and obviously position accordingly.
Jonathan Golub, people have been adjusting to that. How well priced is that story now?
Listen, we're very much, I'm very much on the same page with Anastasia. I think that we have to differentiate between a recession and a slowdown. GDP, if you look on, and you and I have talked about this, if you look at the Bloomberg survey on ECFC, which is a Bloomberg function, it tells you that last summer we were expecting, economists across the industry, about 4.5% economic growth. Right now, the expectation for this year's economic growth is 2.5%. And my guess is by the time the year's over, it's 2%. But that is not a contraction in overall activity. If you look at both the first quarter's GDP and what's expected for the second quarter, is again a weaker GDP number, but a positive consumer spending. Today's report is very much supporting that thesis, which is things are clearly slowing down. Inflation is the big culprit for that, but it's not recessionary, at least not for the moment, and probably not for the next 6 to 12 months.
So, John, what's going on with these retailers? I'll just go through some single names and maybe you can summarize the whole industry for me. Walmart down 11% on May 17th. Apparently that was a surprise. Target down 25% on May 18th. Apparently that was a surprise. Yesterday, Bed Bath & Beyond down 24%. Apparently that was a surprise. And, John, every time I see these retailers come out with guidance, with numbers, I'm surprised people are surprised because we've been talking about these issues for ages. So I really want to lead into this point, John, just how well priced is this story? And will this feel like a recession in certain industries?
Well, I mean, you have to break down what's happening at those retailers. The first thing, and this is a theme that we've been hearing about, this idea that we're going to rotate from buying goods to services. When we were locked down, we all got new flat screen TV and leather couch because we were going to be spending more time at home, and we invested in a new leaf blower to do our backyard and gardens, and we don't need to go and buy those again. So what you're seeing is a rotation away from those purchases to some other things. What you heard from, in particular, Walmart and Target was that they were mismerchandised. They had the things that we've already bought, and so I don't think you have a general consumption problem. And listen, it's getting weaker as much as a shift away from some of the things that we've been spending money on in the past, and that's what you're seeing more than anything else. The second issue at these retailers, and this is something that's interesting, is that margins have held up surprisingly well across the entire S&P 500, but they have not held up well in consumer stocks. So it's not an indication of the health of the consumer, but these businesses, for some reason, are really they're struggling to deliver profits in this environment, which is beyond simply consumer demand.
It's been a massive struggle for that industry. It's been a big, big struggle at the index level too. As we close out the first half, we're down hard so far this year to date. Your base case, Anastasia, I'm just looking at the growth numbers you're expecting here for the US and the Eurozone, likely to slow to 1.5% year over year by the fourth quarter of 22. And then I look at China, it's even more constructive. You think we can rebound to 5% here? So as we look away from maybe the index, the S&P 500, Anastasia, can you walk me through where you're comfortable taking pockets of risk in this equity market, both on an industry basis and also a regional basis as well, geographically, through the year 22 and into the back half?
Yeah, sure, John. I mean, first of all, we should acknowledge that we're not out of the woods here, and we're 3,800 on the S&P 500, and I think there is a chance that we still break below that as we go through the second half, and certain things could break, and they could, consumption is going to slow down. So I do assign a probability that we still maybe get to 3,500. Maybe it's a pretty bad recessionary scenario of 3,300. But having said that, think about where we came from. We're at 4,700 on the S&P 500, and that was not a buying point. But we are now much, much below that. We've almost matched the average recessionary correction or median recessionary correction of 24%. So I would say for long-term investors, we're not trying to time the exact bottom. The risk reward has improved materially if you're looking a year or 2 years out. So with that said, I like some of the cyclical trades right now. For example, financials have been thrown out like a baby with the bathwater, but I actually think if we do engineer a soft landing, that's a place you may want to look at. Energy. I wanted to take profits on energy just a few months ago because I think it's ran a lot in a short period of time. It has pulled back a lot. And if China does in fact rebound, then I do think that this could be very positive for energy prices. And then last is software. Talk about margins. Not interested in retail margins whatsoever, but software margins are quite strong.
A couple of seconds into the opening bow, we're down 1% on the S&P 500. On the NASDAQ, we're down by 1.1. John, I wanted to give you the last word here. Give me your year-end forecast. I know it's constructive, and walk me through why you think it's achievable, given all the risks on the table right now.
Yeah, I mean, listen, I think that we're going to have a double-digit return between now and the end of the year. And I'll tell you what I think drives it. If you look at what we've seen so far this year, profits are up 7.5% year to date, and they'll probably be up another 5 to 6% between now and the end of the year. So we don't have a profit problem as much as people say. What we have is the valuations. The PE multiple is down over 30%, I think 31% on the market. And that's an enormous adjustment, which makes stocks much, much cheaper. So we think that the earnings continue to move forward, and we think that you get a bounce in valuation, probably a couple of multiple points between now and the end of the year. Stocks will still end the year cheaper than they started, and they'll be up double digits between now and December.
John, can I ask you this? Do you think the Fed will be happy to see that?
Yeah, I talk to people at the Fed. I don't think that they are focused on what the stock market is doing. What do they care about? They care about inflation and jobs. I think, so I really think that they're focused on the mission. And I think Powell may be behind the curve, but he's doing a pretty good job of being clear what his focus is right now. Inflation is too high. They have to address that. And that's where they're going to spend time.
John, the reason I asked that, and forgive me for jumping in, isn't the mechanism to achieve that tighter financial conditions? And one element of tighter financial conditions are wider spreads and a softer equity market.
Yeah, but I mean, when you think about financial conditions, and I know that there's some people who define it, including equities, and some who don't. I'm in the camp that you have to look at very simply. If you wanted to borrow money, is it available to you? Let's take a look at the things that I care. Again, I'm talking about what I pull off my Bloomberg terminal, but the Bloomberg, index for bankruptcies is at record lows. That's not what happens when you're going into recession. That's not what happens when the economy's melting down, that fewer and fewer people are going bankrupt. You would need to see that spike if you're going into recession. If you look at people who are defaulting or businesses defaulting on loans or not making loan payments, we're not seeing that at all. Anastasia was talking about a soft landing, but in many ways, this environment there's this. If you look at the stock market, you feel like it's a recession, and then you look at these metrics on the health of the credit market, and it just doesn't feel recessionary. So I don't think the Fed is going to obsess on the stock market and blink on that. They will blink if the consumer falls apart, that's a whole different issue. They care about the consumer, they care about jobs, they care about spending.
John, good to catch up, mate. Looking ahead to a more constructive view from Jonathan Golliver, the team at Credit Suisse for the second half of this year, to Anastasia Amoroso of iCapital on her mid-year outlook. Thank you very much to the both of you. Getting things open underway to close out the first half. Brutal start to 2022. Gets uglier going into the end of it. We're down by 1.3% as we close out Q2 on the S&P 500. We're down 47 points with some movers. Is Abby?
John, well, that recession debate really front and center with today's weak start. 4 down days in a row for the S&P 500 this week, down about 3.5%. And as we were mentioning, one of the worst starts for the S&P 500 in several decades. Taking a look at what is moving beneath that brutal surface, we have Apple down, the heavyweight to all of the indexes, down 1.3%. Even with yields in, the tech investors not going for the stock as valuation concerns become less of a concern. Investors are worried. Bank of America down 2.4% with that rally in bonds and yields in. RH, you were just talking about the surprise that investors seem to have around some of these retailers cutting guidance. Well, RH cutting guidance for a second time this year on slowing demand, down 7.5%. And Carnival Corp down 3.6% after sliding 14% yesterday, as Morgan Stanley says that the company could be facing a wipeout. This again against the backdrop of a potential recession and a wipeout in consumer demand, John.
Abby, thank you. It has been brutal for tech stocks, closing in on their worst performance for a first half in 20 years. JP Morgan cutting its earnings forecast on some of the biggest names, running the following. Our biggest estimate reductions come in online advertising and e-commerce. Given the macro pressures, we are increasingly cautious around the impact of a broader economic slowdown, as ad spending is highly correlated with GDP. On the West Coast, let's get to Ed. Morning, Ed.
Yeah, good morning, John. We're down 1.4% on the NASDAQ 100, almost every single name in the red. It's interesting that JP Morgan call kind of undermines the idea that because we've seen such declines, we're in cheap territory, that valuations have come down to a cheap level. Not really the case. We're on track for our worst first half of the year on the NASDAQ 100 since 2002. I wasn't around doing this in 2002, but that's quite a stat to reel off. Look at this chart in the Bloomberg terminal, though, because there is a split on Wall Street. You look at some of the biggest names, mega caps in particular, and there is still bullishness, at least if you look at price targets. And what I think is so interesting is I hear a lot of names, and I believe your last guest mentioned this as well, talking about free cash flow yields and other metrics that are indicators of value, right? We do talk about value buyers potentially coming back in, but we're also questioning if we've seen the bottom yet. The other interesting call, especially with regards to what Powell said yesterday and this idea of whether or not the economy can withstand tighter policy, is to look at Amazon. You know, I think Amazon was one of the names that they cut, but they could benefit in this recessionary environment because they offer lower prices, quick delivery. But if the consumer is soft, is that really the case with a name like Amazon? There's a lot of moving parts here. Earnings season, I'm very excited, Jonathan.
I'm sure you are. I'm looking forward to it. It kicks off July 14th with JP Morgan, unofficially anyway. Ed Ludlow, thank you. The retailers have been a pretty poor story. The interesting thing for me about the retailers is that they come out and give you a negative guide, and then a month later, seemingly, they give you another negative guide. Restoration Hardware has been doing just that. They came out, they give you a softer guide, and then they had to come out again yesterday and do it all over again. They said this: the deteriorating macroeconomic environment has resulted in lower than expected demand since our prior forecast, which wasn't that long ago. Our expectation is that demand will continue to slow throughout the year. Kelly Lyons has more. Hi, Kaylee.
Hey, John, well, you hit the nail on the head. It is how quickly things are deteriorating for these retailers that is really remarkable here, because we know Restoration Hardware is not alone. We've seen similar moves from Target, for example, all met with really punishing market action the day after. If you think it's bad for technology this year, try being a retailer, because that is the group of stocks that is actually underperforming even tech, on pace for the worst year going back all the way to 2008, globally down about 30%. The story here really being that inflation is putting pressure on the consumer. We saw that reflected in the spending data we got out earlier this morning, and that in turn puts pressure on retailers' ability to pass on the higher input costs they are facing and creates margin pressure. And this is really true across the board. No matter what segment of retail you look at, be it the department stores or e-commerce, specialty retailer, even food retailers, which fall more into the staple than discretionary category, all of them are down double digits on the year. And yet it seems, as is the story really broadly with the analyst community these days, they are a lot more optimistic than investors are, because when you look at the gap between 12-month price targets and the actual stock price for the consumer discretionary sector, it's the second widest of any major sector, 28.6%. So clearly the sell side see some upside as we move into the second half, John.
Kelly Lice, thank you. I want to keep it on the consumer. David Costin at Goldman Sachs putting out some brilliant research going into the last weekend, saying the following: declining consumer spending represents a threat to earnings for consumer discretionary stocks and the autos industry group in particular, especially in the case of a recession. David Costin joins us right now. David, let's start there. The consumer. I want your thoughts on what you're seeing and where you think this is heading.
Well, the consumer balance sheets are in excellent shape. The concern would be on the discretionary spending, given the higher cost of food and energy costs and things like that. So the consumer discretionary stocks heading into the second half of the year, one of the biggest concerns will be the margin pressures that they've experienced. And I see that, you saw that in some of the Target as an example. You mentioned earlier about the inventory problems, some of the guide down, but they also raised their dividends by 20%. So I think the belief on the part of many management teams is that this is a more temporary pressure, and the fundamentals of the business remain, modest. And our preference would be more companies that are more resilient in that, and that's going to probably be in the healthcare sector, consumer staples, where you have less margin vulnerability. That's been the long-term pattern in a downturn or recession, that their resilience in their margins is much more powerful than consumer discretionary, where they typically go down pretty significantly, and that leads to lower earnings, and lower earnings, Jonathan, as you know, typically presage lower share prices.
David, if we ask Jan Hatzius about that consumer balance sheet, the strength of the consumer, I think he'd say the same thing. I'm interested in whether there is a different story away from the headline, away from the aggregate numbers that we talk about consistently on shows like this when we talk about the strength of the consumer. David, do you see a different breakdown when you look at low-income households to high-income households? And does that shape your view on where you want to be in pockets of this stock market?
Oh, yes, we did. I mean, the consumer spending is definitely challenged as you look out into the calendar year and into 2023 in particular. So the lower quintile of the income distribution here in the U.S. is going to see, probably a roughly 9% decline in their discretionary spending ability. And even at the highest end of the quintile, in terms of that broader distribution, is probably flat. And so there's still a lot of challenges and so the headwinds of higher costs around energy and mortgage rates, sort of discretionary spending is going to be pressured, food costs, a lot of pressures. And that's why focusing more on more business-oriented sort of companies where their end market demand is coming would be a preferable area in terms of positioning a portfolio right now.
I want to talk about the price of the story too, David. These issues, inventories at retailers, the change in spend from goods to services, we've been talking about this for a while. We know it's happening, and yet the companies come out and say it, and we get this massive gap lower in the stock. Why do you think that is, David? Why is a story that's talked about so much so poorly priced still?
Well, it's a good question. Look, that's where the sort of the investable gap is, that the idea of earnings degradation has been pretty slow in terms of the negative revisions. The normal pattern, Jonathan, is you get about a 10% or so cut in estimates in the sort of months ahead of a recession, and then you go into recession and the earnings get cut by another 15%. And so the stock market tends to trade ahead of that. So that's the degradation or the degradation of the profit forecast. Stock market moves a lot faster. So that would be the explanation. It basically, the market's going to act first and worry about the adjustment in profit forecasts later, which is why the idea of, where are the companies? What companies have more resiliency? Where have you seen a stable growth? You see Comcast, you see Google or Alphabet, you can see Colgate-Palmolive, you can see of somebody like Amgen, you can think of companies, Johnson & Johnson, which they have demonstrated ability over many years to have stable growth. Not necessarily the fastest growth. In some cases they are and they aren't, depending on the year. But those are the attributes that investors should be looking for in this environment that we're looking at right now. We're about to start the second quarter earnings season, kick off in about 2 weeks. And the expectations right now is about positive 5% year-over-year growth. That includes the energy sector, of course. And if you take out the energy, you're looking at down 3%. This will be the first time we've seen year-over-year declines in earnings. That's if the expectations are realized. Still, that's a negative year-over-year growth. That's tends to be a concern. It's one of the reasons why the vulnerability is going to remain in the market for the third and the fourth quarter, where expectations right now are for double-digit growth year over year, and that's probably likely to come down a lot as a result of both the results for the second quarter and then more importantly the guidance looking forward. Jonathan,
the stocks are down hard again. We're down 1.6% on the S&P. On the Nasdaq, we're down by 2%. David, before we talk about something out in the next segment, I want to talk about year-end price target in just a moment. Can we finish on this on households? They're getting hammered. Now, David, you did some work going into the weekend about just the household holdings of equities and what you think will happen with them. And it sort of goes against the grain a little bit, David. Can you walk me through on what you and the team are looking at?
Well, right now you've seen actually positive inflows into equities in the first quarter, about $75 billion. We've seen that as well. Got a year-to-date, probably closer to $100 billion. So there's a lack of alternatives. I know in the last several years, the TINA acronym, there is no alternative, has meant equities particularly attractive. So obviously prices have come down a lot. And the question is, what are the other alternatives now? There are some. Cash is, by the end of the year, maybe yielding 3%. But bond yields have been negative, been a bear market effectively in bonds and in equities. So still there are some parts of the equity market that are more resilient, and that's an area that likely to see more inflows. The biggest source of demand is really corporate buybacks. Now, we're in a period of time now where in the blackout period where companies are precluded from repurchasing on a discretionary basis. So stock prices are down a lot. Look at the Goldman Sachs buyback desk, and there's actually extraordinary amounts of repurchases, accelerated stock repurchases that were completed just before, in some cases, the blackout period. And when the earnings season is finished and companies report the results, they're probably likely to move back and repurchase stock. Obviously, buying it down at these levels is obviously much more accretive than it was 20, 30% higher.
David, stay right there. We need to talk about year-end price target in this Federal Reserve. We'll do that in just a moment. David Costin there at Goldman Sachs with us for at least 5 more minutes. We're down 1.6 on the S&P. On the Nasdaq, we're down 2%. Coming up, central bankers reaffirming their pledge to tame inflation.
Is there a risk that we would go too far? Certainly there's a risk. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
That's next. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think the bigger mistake to make, let's put it that way, would be to fail to restore price stability.
Could he be any clearer? Chairman Powell of the Federal Reserve. Equities down 1.6% on the S&P. On the NASDAQ 100, we're down on the NASDAQ. We're down by about 2%. On a session lower on the quarter. Ugly on the quarter on the S&P 500, down 17%. Lucky to conclude this morning with David Kostin at Goldman Sachs. David, I want to come straight to you on your 3-month price target, which was out about a month ago, so I imagine it's a 2-month price target now, and your longer-term price target, and this idea as to whether the Fed put is now a Fed call, and ultimately they do not want to see an easing of financial conditions and a rally in this equity market. Your thoughts on that, sir?
Absolutely. The view here at Goldman is one of the transmission mechanisms to slow the economy is through tightening financial conditions. And so the first order would be the Fed raising the funds rate, which of course it is doing. But the other components of the financial conditions index would be bond yields, credit spreads, the dollar, equity valuations. Those are other building blocks of a tightening financial conditions environment or loosening to the other extreme. And to the extent that equity prices or valuations were to rise, that would be orthogonal or at cross purposes with the goal of tightening financial conditions. Therefore, I would put down as sort of 4,000 would be a level, sort of a ceiling over the next several months. It would be difficult for equity prices to kind of pierce that level on the upside. And that would be the idea if that was to be happening. The Fed might have to be leaning harder into forward guidance and things like that. So our general view here is that the idea of limited or sideways move in the equity market, it's been mostly moving, Jonathan, in the 3,700 to 3,900 range for at least the last month or so. 20% of the trading days this year, the market's moved more than 10%, more than 2% in a day, which is, extremely, it's 2.5 times more levels of volatility than you've seen daily moves over the last, 20 years in terms of the frequency and the magnitude of these big moves. So the idea of looking out towards the end of the year, the sort of baseline scenario would be if the Fed has and inflation starts to recede in the fall, that would allow equity prices perhaps to move higher. Alternative scenario would be recession, and in a recessionary environment, in a scenario, you're probably looking at a level of the market around 3,150, and the sort of transmission mechanism for how that happens would be a series of significant negative earnings revisions across the market, kind of looking into 2023, and that would take a consensus number right now around $250 for next year in profits. That would probably take that down closer to 200. And then that transmission mechanism, as it sort of degrades, we talked about in the previous section, that would probably lead to a multiple that goes a little bit lower. The idea of the equity market having derated from 21 times earnings to around 16 times or so now, 16 times forward earnings, that's been the total driver, the significant driver, higher rates, lower equity prices. We just haven't seen it on the earnings front. So that's the idea that we would lay out as a strategy and the sort of thought process. And we want to inoculate or eliminate some of the downside risk. And that's why that earnings stability is such an important variable, an attribute of companies in this environment. If the economy was growing more rapidly and rates were lower, you might look to lean in towards more growth. That's not the environment we're looking at right now, and that's why the value of those stable companies is to be prized from a fund manager point of view.
David, this is really important stuff, and I'm still not sure everybody gets it. David Kostin, thank you, sir, of Goldman Sachs. Just on this idea that we've gone from a Fed put to a Fed call. Chairman Powell validated what we've seen in this market. Mike Schumacher of Wells Fargo said earlier this morning, what we've seen is a feature, not a bug, and we're going to see more of it. Chairman Powell said this yesterday. Markets have been pretty well aligned to where we're going. Where we're going next is your trading diary. That's next. This is Bloomberg.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Big cracks in credit over the last couple of days. High yield spreads breaking out through 550. That's on a table getting very, very close to that level. We're down 1.9% on the S&P. On the Nasdaq, we're down 2.4%. An ugly end to an ugly half. We're down more than 21% so far year to date on the S&P 500. That's the price action. Here's your trading diary. President Biden heading back to the United States later today. Tomorrow, the big data point, the ISM manufacturing numbers and monthly auto sales in the United States, plus PMIs out of the Eurozone. And I believe we get headline CPI too. Remember, a long weekend stateside, so Monday, no trading. Markets close for Independence Day. The FOMC minutes coming up on Wednesday. And finally, of course, looking ahead to next Friday, the payrolls report to round out the week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now.